Please like, share, and subscribe. Wishing you happiness and good luck every day.
Have you ever looked at the stock market and just seen this massive world of opportunity, but at the same time, a totally complex and kind of intimidating challenge? Well, what if you had a clear, actionable playbook? That's exactly what we're doing today. We're distilling the core methodology from Dr. Thomas K. Carr's book, Trend Trading for a Living, to give you just that. Right out of the gate, the book just hits you with this hard truth from trader Alan Farley. This isn't some get-rich-quick scheme. It's not a lottery ticket. The market does not just hand out free cash. It's a serious pursuit that demands dedication and, most importantly, a solid strategy. And that really sets the stage, because if it's that tough, you absolutely need a proven plan. And that leads us to the big question, right? If most people who try their hand at trading don't actually succeed, what's the difference maker? Is it just dumb luck? Are they geniuses? Do they have some secret insider info? Well, according to this playbook, it's none of that. It's all about having a system, a process that gives you a real edge. Okay, so here's our game plan. We're going to start with the big challenge. Then we'll define the solution with trend trading. After that, we'll break down the core two-part system, see how you actually build your playbook, cover the mindset you need to succeed, and then wrap up with your path forward. First things first, let's just embrace the core challenge here. So many traders fail because they're just reacting emotionally. They're chasing hot tips, they're jumping on bandwagons, and they completely lack a disciplined method. And this is precisely the problem that a systematic approach is designed to solve. So what is this solution? It's called trend trading. And look, it's not about trying to be a hero and get in at the absolute bottom or sell at the absolute top. The goal here is way more practical. You identify an established trend, whether it's going up or down, and you ride the main part of that move. And that holding period, from a few days to a month, it really puts it in a strategic sweet spot. So where does trend trading actually fit in all of this? Well, it's not the slow, super patient game of buy and hold investing that can take years to pay off, and it's definitely not the frantic, high-stress world of day trading where you're in and out of positions in minutes. You can really think of it as a middle path. It's active enough to capture significant moves, but it's manageable enough that you won't burn out.
So, the crucial question is, how do you actually do this effectively? How do you find these trends and then trade them with confidence? Well, this brings us to the very heart of Dr. Carr's system, this two-part approach that really gives you a professional-level edge.
Most technical traders, they live and die by the price chart. They're looking for patterns, indicators, all these signals to tell them when to buy and sell. And while that's a key part of the puzzle, Dr. Carr argues that relying only on charts is like trying to navigate with just a compass but no map. Sure, you know which way is north, but you have no idea if you're about to walk off a cliff.
The pro's edge, and this is really the secret sauce of the whole system, is a two-part approach. It combines two incredibly powerful forms of analysis to create a process that's just so much more robust and reliable. It's about finally adding that map to your compass.
And the logic here is just perfect. Step 1 answers the question, what should I trade? You use fundamental analysis, you're looking at a company's actual health, its earnings, its sales, to filter the entire market down to a manageable watch list of strong companies to buy or weak ones to bet against. Only then, once you have that list, do you move to step 2, which answers, when should I trade? And that's where you pull out the charts to find the precise moments to get in and get out.
And here's why this is such a game changer. When you try to trade a breakout, that sudden surge in price on a stock that has really weak fundamentals, that move fails a lot. But when you trade that same breakout pattern on a company that's fundamentally sound, there's a real business reason for other investors to jump in and support that move, and that greatly reduces your risk.
Okay, so that's the theory. It's powerful, it's logical, but what does it actually look like in practice? Let's walk through the process of building your actual trading playbook, starting from the entire market all the way down to a single trade.
Step 1 starts here, with the entire universe of stocks. It's overwhelming. The book shows you how to use stock screeners with very specific fundamental criteria that act like a giant sieve, catching only the highest quality companies and letting all the junk just fall away. This turns what seems like an impossible task into something focused and totally manageable.
So once you have your hand-picked watch list, then you move to the charts. This is what Dr. Carr calls eyeballing the charts. It becomes your daily discipline. You're not guessing here. You're actively scanning for specific, predefined patterns, or setups, that signal a high-probability opportunity might be forming.
So what does a setup even look like? Well, here's a classic example right from the book, the pullback. The logic is so simple and so powerful. You've already identified a fundamentally strong company that's in a solid uptrend. All you do is wait for a temporary price dip, a pullback, and you essentially buy it on sale right before the primary trend kicks back in. This is trend trading in its purest form.
Okay, now we get to a really important part. You can have the best system in the world, the best tools, the fastest car, but if the person behind the wheel isn't disciplined, they are going to crash. And that brings us to the crucial psychological side of trading.
The book actually dedicates an entire chapter to this, laying out 10 specific habits that separate the pros from the amateurs. It's this recognition that trading success is ultimately a game of discipline, not just good analysis.
Now, while the book lists 10 habits, a few of them are just absolutely non-negotiable. First, you have to know the general market trend and trade with it, not against it. It's way easier to swim with the current than against it, right? Second, you have to manage your risk before you even start dreaming about profits. Why? Because you can't stay in the game long enough to win if you blow up your account. And that means knowing your exit point before you even click the buy button. And finally, keep a detailed journal. This isn't just for your records, it's your personal feedback loop so you can learn from your wins and your losses. Ultimately, these habits prove that in trading, discipline beats brilliance every time.
After all that talk about systems and discipline, which can sound a little intense, Dr. Carr leaves us with this incredibly empowering thought. He just boils it all down to its simplest essence. The system is designed to make the complex simple. If you can just follow the rules, the mechanical part of actually placing the trade is easy. It makes this whole professional-level pursuit feel, well, accessible.
And that brings us to our final word on this approach. It really is about combining a powerful logical system with your own personal discipline to navigate the markets with real confidence.
This last piece of wisdom is just perfect. Successful trend trading isn't about predicting the future. It's not about imposing your will on the market. It's about listening to what the market is telling you through price and through fundamentals, and then humbly aligning yourself with its most probable direction. So we'll end here. This playbook, it provides the map and the compass, a clear, logical system for navigating the markets. But you know, a map is not the territory. The ultimate question, the one you're really left with, is whether you have the discipline to follow that map, day in and day out, on your own trading journey.
You know that feeling when you see a stock chart just taking off like a rocket? And you think to yourself, man, I gotta get a piece of that action. Well, that instinct, that idea that a rising stock is just gonna keep on rising, that's the whole heart of this hugely popular thing called technical analysis. But does it actually work? Today, we're gonna put that idea to the ultimate test, and we're gonna uncover a really surprising twist that shows exactly why most trading systems based only on charts fail, and how 2 super simple fixes can turn a total disaster into an absolute powerhouse of a strategy.
So, here's what we're gonna do. First, we'll dive into why trading on charts alone is so tempting. Then, get this, we're gonna watch that whole idea just completely crash and burn. But, out of those ashes, we're gonna find a solution. 2 surprisingly simple filters that flip the whole thing on its head. You're definitely gonna wanna stick around to the end because the big takeaway here changes the entire conversation.
All right, let's get into it. For a lot of people, technical analysis is kind of the holy grail. It's this idea that you don't need to worry about what a company actually does, or who's in charge, or even if it's making any money. Nope. The only thing that matters is the chart. At its core, technical analysis is built on this one really bold idea. Everything you could possibly need to know about a stock is already baked into its price. You can just forget about reading all those boring earnings reports or trying to keep up with company news. The chart, they say, is the ultimate truth teller. The belief is that you're not really trading a business, you're just trading the patterns of human psychology, the fear and the greed, believing that what's happened before is bound to happen again. But this is where things get really, really interesting. Some of the greatest investors of all time just completely dismiss the whole thing. I mean, Warren Buffett's quote here is an all-timer. He's basically calling it financial astrology. So that sets up this huge divide, right? You've got this army of traders, the chartists, who live and die by these squiggly lines. And then you have legends like Buffett saying it's all just noise. So who's right?
Well, you know what? Let's stop guessing and let's settle this with some cold, hard data. We're going to build a trading system based on the purest form of this idea. Just raw price momentum. No opinions, no fundamentals, none of that. We're just going to buy what's going up the fastest. Let's see how that goes.
Okay, so here are the rules for our little experiment. First things first, we got to get rid of the junk. The tiny penny stocks and companies nobody's trading. Then we apply what you can think of as a momentum funnel. We're looking for stocks that are crushing the overall market over the long term, the medium term, and the short term. The goal here is to find the absolute hottest of the hot, the top 3 stocks with the most explosive, consistent upward climb.
So just think about that for a second. We are systematically buying the stocks with the most powerful upward momentum, the ones that are just screaming higher. On paper, this sounds like a killer strategy, right? So let's run a back test, which is really just a simulation to see how it would have done in the past. If you put 10 grand into this system and let it run for 5 years, where do you think you'd end up?
And the result is an absolute spectacular failure, a mind-blowing loss of 96.1%. Your $10,000? Gone. It's now worth just $388. And to make it even worse, if you had just bought a simple S&P 500 index fund, a basket of the 500 biggest companies, and just left it alone, you would have almost doubled your money. This strategy didn't just fail, it actively lit your money on fire.
And this chart, wow, this shows you exactly how it all went down. And it is a classic trap. See that little peak at the beginning? For a minute there, you'd think you were an absolute genius, you're up over 100%, but that was the bait. What came next was a complete and catastrophic collapse, a brutal, steady march down to zero. This is the perfect picture of what happens when you chase hype without any substance.
Okay, so that was a train wreck, a jaw-dropping failure. And it forces us to ask a much better question. The question isn't, does momentum work? It's, okay, what was so wrong with that kind of momentum, and how in the world can we fix it? And that brings us to the real heart of the problem. It turns out momentum itself isn't necessarily bad. The problem was that our system was chasing hollow momentum. It was basically buying rocket ships that had no fuel in the tank, stocks that were soaring on nothing but hype and speculation, with no actual valuable business underneath them. The fix then isn't to just give up on momentum, it's to anchor it to reality. And this is where it all turns around. The author discovered that by adding just 2 simple reality checks before we even look at momentum, the entire outcome is reversed. And we're not talking about some complex algorithm here. These are just 2 powerful common sense filters that ground the whole strategy. The first filter is all about valuation. We use something called the price to sales ratio. Now, why sales instead of profits? Well, because a lot of these awesome high-growth stocks might not actually be profitable yet. A price-to-sales ratio under 1 basically means you're paying less than $1 in stock price for every dollar of the company's annual sales. You can think of it like the price tag on a business. It's a fantastic way to find companies that aren't ridiculously overpriced. Our second filter is all about surprise. The Zacks rank is basically a tool that sniffs out companies that Wall Street analysts keep underestimating, in a good way. It looks for companies that are consistently surprising everyone by earning more money than they were expected to. When that happens, the stock price often gets a really powerful and lasting kick. So you can think of this filter as our surprise detector. So here it is, our brand new system. It is the exact same momentum funnel as before, but now we've put 2 fundamental gatekeepers right at the front door. A stock can only even be considered for its momentum if it first proves that it's a reasonably priced company with a brightening future. All right, this is the moment of truth. We've added our 2 magic filters. We're running the exact same 5-year backtest. What do you think happens now?
And the results are just unbelievable. It's a total 180. On the left, you see the original dumpster fire, that 96% loss. Now look at the right. With just those 2 simple filters, that catastrophic loss turns into a 249% gain. Now, the S&P 500 returned about 92% during that time. Our new system more than doubled that. We went from a wealth-destroying machine to a genuine market-crushing strategy, just by adding a little bit of common sense. But it didn't even stop there. The next question was, okay, how fast should we be moving? If these are good companies with strong momentum, maybe holding them for 4 weeks is too long. The good news might get priced in faster than that. So what happens if we check our portfolio every 2 weeks instead? The result is another huge leap. The 5-year return more than doubles again to an incredible 581%.
And that leads to the final tweak. What if we tighten the leash even more? By rebalancing every single week, the results just go into the stratosphere. And this confirms a really important insight.
For fundamentally strong companies, momentum is a powerful force, but it's also a fast-moving one. You've got to be nimble if you want to catch it.
And here it is, the final mind-boggling number, a 1,451% return over 5 years. Let's really put that in perspective. Our first experiment, the disaster, turned $10,000 into $388. This final refined strategy, it turned that same $10,000 into more than $155,000. Just look at this equity curve. Seriously, remember that first chart we saw, the one that looks like it fell off a cliff? Well, this is its polar opposite. This beautiful, steady, powerful climb upwards, this is the visual proof of what happens when you combine smart momentum with solid fundamentals. It is a complete and total reversal. So after this wild ride from total failure to massive success, what's the one big idea we should really take away from all this? The big takeaway is this. That whole debate you always hear, charts versus fundamentals, it's a trap. It's a false choice. The real power, the magic, comes from making them work together. You use fundamentals to answer the question, what should I buy, to find those great businesses. And then you use technicals, like momentum, to answer the question, when should I buy it? It's the difference between trading a business and just chasing squiggly lines on a screen. And so we'll leave you with this one last thought. The next time you see a stock that's just soaring, ask yourself this one simple but really powerful question. It might just be the filter that separates a catastrophic loss from a truly beautiful winner.
Welcome to our explainer. Today, we're diving right into Chapter 2 of Trend Trading for a Living, all about the tools of the trade. And you know what? We're skipping the theory and getting straight to the practical stuff. We are going to walk through the author's exact blueprint for building a professional trading command center right from your own home. We're talking everything from the computer itself to the software that makes it all happen. Right from the start, the author makes one thing crystal clear. Trend trading is a totally different kind of business. And this quote, it just nails it. You're basically getting rid of all the usual business headaches. Forget about managing inventory, dealing with customers, or making endless sales calls. This is business boiled down to its absolute essence. Just you, your strategy, and the market. So here's our game plan for today. First, we're going to dig into the why. What makes this such a great home business model? Then, we'll roll up our sleeves and get into the real nitty-gritty. Building your trading computer, loading up your digital toolbox with the right software, and of course, plugging into the market. And we'll wrap it all up with a final checklist to make sure you've got every single tool you need.
So what is it that makes trend trading the ideal home business? Well, according to the book, it really comes down to two big things. The barriers to entry are incredibly low, and the whole structure is just simple. Unlike pretty much any other business out there, you don't need a mountain of cash or some super complex business plan to get going.
Now this number, this is the one that really makes you stop and think. The author suggests that your potential profit margins could be over 90%. I mean, think about that for a second. With almost zero overhead, no staff, no rent, no marketing, the vast, vast majority of the money you bring in is pure profit. And understanding that, well, that's why it's so important to invest in the right tools from the get-go.
So, what's actually on the shopping list for this low-overhead business? It's refreshingly simple, really. First, a good chair. That's not negotiable, trust me. Then, a modern computer. Plenty of screen space, a fast internet connection, the right software, and yeah, the old classics, a pen and some paper. So, let's zoom in on the tech that's going to power this whole thing.
All right, let's get into it. Building your trading computer. Look, this is the absolute heart of your operation. It is the foundation of your entire business. Getting this part right is, well, it's everything.
Okay, so when you're piecing together your machine, the author makes one thing incredibly clear about where your money should go. Forget about chasing the fastest, fanciest processor. A decent mid-range one is totally fine. The real killer, the thing that will bring your trading to a grinding halt, is not having enough memory, or RAM. Think of it like this. RAM is your desk space. A fast processor is like a quick brain, but if your desk is too small to spread out all your charts and data, your brain gets cluttered and slows down. That's why having a good 8 to 16 gigabytes of RAM is absolutely crucial. It's what prevents your system from freezing at the worst possible moment. And that brings us perfectly to the next piece of the puzzle, your visual workspace. The idea here couldn't be simpler. The more screen space you have, the better you're going to trade. You can't be constantly clicking and flipping between windows. You need to see everything. Your trading platform, multiple charts, news feeds, all at a single glance. So the solution? is either one gigantic monitor or, even better, a setup with multiple screens.
Now, to make this all a bit more real, the author shares the exact specs for their personal rig, which they call the Orion. And as you can see, this is no ordinary desktop. It's purpose-built for performance. We're talking a powerful Intel i7 processor, a military-grade motherboard for reliability, and a graphics card that can run 4 monitors at once. You add 16 gigs of fast RAM and a super quick solid-state drive, and you've got a machine that's designed for one thing and one thing only, trading without any hiccups.
And here's the machine itself. The author mentions that they actually partnered with a specific company for this build, Trading Computers USA, because they specialize in putting together rigs for traders without a crazy markup. The book even gives you a discount code if you want to follow their exact path.
Okay, the hardware is set. Now it's time to load up our digital arsenal. Section 3 is all about the software. These are the tools you'll be using day in and day out to find, analyze, and make your trades.
The very first tool the author says is an absolute must-have is finviz.com. And the best part? It's totally free. Now, it's got plenty of real-time data and news, but its real secret weapon, especially for the strategies in this book, is its incredibly powerful stock screener.
And here's a perfect example of what FinViz can do. The S&P 500 heat map. Just look at that. In a single glance, you get this amazing visual snapshot of the entire market. You can see which sectors are hot, which are not, and which individual stocks are making moves. It's probably the fastest way to get the pulse of the market at any given moment.
All right, now for charting. When it comes to charting, the author has a very, very strong favorite, another free service, tradingview.com. They actually call it, and I'm quoting here, the best web-based technical charting package available. That is some seriously high praise. So let's see what the fuss is about.
So first off, the charts are just beautiful. They're clean, they're bright, they're super easy to read. A lot of other platforms can feel really clunky, but TradingView gives you this huge widescreen canvas that just feels intuitive. You can zoom in, scroll back through time, it all just works.
But it's not just a pretty face. Where TradingView really starts to pull away from the pack is with its advanced tools. As you can see, you can map out really complex patterns, you can apply all sorts of technical studies, and you can project potential price moves with a level of detail that, according to the author, you just won't find on any other web platform.
Okay, now this right here might be TradingView's killer feature. It lets you look at a single stock across 8 different time frames, all at the same time. We're looking at Tesla here, from the long-term weekly chart all the way down to the 1-minute chart. For a trader, being able to do that kind of deep, multi-time frame analysis on one screen, it's an absolute game changer.
Now, for traders who are ready to take it to the next level and start automating their analysis, the book points to a high-end, paid software called MetaStock. This isn't really for beginners, but for serious traders, it's got some incredibly powerful tools for screening the market, backtesting strategies, and getting real-time trade alerts.
And what makes MetaStock particularly interesting here is that the author actually worked directly with the company. They collaborated to create a special add-on called the Trend Trading Toolkit. What this does is it basically programs the exact trading systems from the book directly into the software. So it lets users automate the entire process of scanning and finding potential trades. Pretty cool.
Okay, we've got our computer, we've got our software. The very last technical piece of the puzzle is connecting all of it to the market. This is your lifeline. These are the services that feed you live data and let you actually place your trades, your internet and your broker.
When it comes to your internet connection, the author's advice is simple and direct. Get the fastest, most reliable connection you can possibly get. Seriously, when you've got real money on the line, a slow or unstable connection is just not an option. And just as a point of reference, they share their own setup, a cable connection that's pulling down over 900 megabits per second.
And finally, the broker. The author's #1 recommendation for active traders is Interactive Brokers, or IB. And as you can see from this breakdown, it's all about keeping costs down and getting access. They have some of the lowest commissions and margin rates, that's what it costs to borrow money to trade, in the entire industry. Plus, they have a huge list of stocks you can short sell. So what's the catch? Well, their trading platform is professional grade, which means it's insanely powerful, but it definitely has a steep learning curve.
And that brings us to the finish line. Let's do a quick run-through of the complete toolkit. Everything you need to be ready for action.
So, let's wrap this up. We've just laid out the entire blueprint for a professional-grade trading command center, We're talking a powerful computer loaded with RAM and screen space, a suite of amazing free software for analysis, a rock-solid internet connection, and a low-cost broker. The hardware is picked out, the software is installed, your command center is officially built. But that brings us to the author's final and most important point. Having the tools is just the first step. The real question is, are you ready to build the skill and the strategy to actually use them?
Welcome to The Explainer. Today, we are tackling the language of the market itself, the price chart. It's really the heartbeat of finance, showing every single trade, every hope, every fear. And you know what? By the end of this, you're going to understand its rhythm.
So if looking at a chart like this, with all these lines and bars and graphs just makes your head spin, don't worry, you are in exactly the right place.
I get it, this might look like a totally foreign language right now. But every single one of those little squiggles is telling a story of fear and greed. And I promise you, by the end of this explainer, you won't just be able to read that story, you'll actually understand it.
All right, here's our game plan. First, we're going to build your personal toolkit with 6 key indicators. Then, we'll use those tools to see the bigger picture, the overall market trends. And finally, we'll talk about the one secret weapon that really separates the pros from everybody else. Okay, let's get started.
Okay, first things first, let's build your analysis toolkit. We are going to break down the 6 most essential indicators out there. What our source material calls, and I love this, the sexy 6.
These are our core instruments. Now, each one has a very specific job to do, giving us a totally different angle on what the price is doing. We're going to walk through them one by one so you really get what it does and, probably more importantly, why it works.
First up, we've got simple moving averages, or SMAs. Now I want you to think of these like rivers of price consensus. They smooth out all that messy day-to-day noise to show you the average price over time. And when the current price wanders too far away from that average, well, it usually feels a natural pull to come back. And right here, you can see that theory in action, plain as day. Look on the left, those upward sloping averages are a textbook confirmation of an uptrend. And notice how the price keeps bouncing off that faster 20-day line? It's like a moving floor, supporting the price all the way up.
Next up is the MACD. That stands for Moving Average Convergence Divergence. This one is all about momentum. It basically asks, who's in control right now? Is it the buyers, the bulls? That's when the indicator's above the zero line. Or have the sellers, the bears, taken over? Well, that's when it's below.
And this chart just shows its power perfectly. Through that whole big uptrend, the MACD is hanging out way above the zero line, right? But look at that crossover in late January. That was your early warning that momentum was shifting. And when it plunged below zero in February, that confirmed the bears were 100% in charge.
Our third indicator is stochastics, and you can think of it like an exhaustion meter for the market. It measures where a stock closes compared to its recent high-low range. So when it gets up above 80, we say the market is overbought. And when it drops below 20, it's oversold. It's basically trying to spot when a price move might be running out of gas.
But here's a really key pro tip. In a strong, charging uptrend like the one you see on the left, a market can stay overbought for a very, very long time. This is exactly why the pros often use stochastics with another trend indicator. If the moving averages are pointing up strongly, they might just ignore those overbought signals until the trend itself starts to look tired.
Okay, on to on-balance volume, or OBV. This one reveals the real power, or lack of power, behind a price move. Think of it like a giant scale, constantly weighing buying pressure against selling pressure. It just keeps a running total of the trading volume, adding volume on up days and subtracting it on down days.
Now, the whole point here is confirmation. Just look at that middle section. The price is climbing higher, right? But the OBV line is totally flat. That's telling us the buying volume just isn't there to support the move. And that is a huge clue because so often volume leads price. This disagreement is a serious warning sign that the trend is weak and really vulnerable.
Next up, the Relative Strength Index, or RSI. Now, like stochastics, this is a momentum tool that helps spot overbought and oversold conditions. But here's the difference. While stochastics cares about where the price closes in a range, RSI measures the speed and the size of recent price changes. It's all about gauging the raw strength of a move. And you can see just how powerful this can be on the right side of this chart. In April, the price is still dropping, but look down at the RSI. It hits that oversold level below 30, and then it starts to climb before the price itself bounces. This is called a leading divergence and can be a fantastic early signal to get in a trade. Our final tool is the Commodity Channel Index, or CCI. This one was built to do one thing and do it really, really well. Spot the very beginning of big, powerful new price moves. And it does that by measuring just how far the current price has strayed from its statistical average. And just check out this chart. It's a perfect illustration. For a pretty stable stock like this, almost every single time the CCI hit an extreme level down below -200, it marked a major bottom. And sure enough, a sharp reversal from bearish to bullish followed right after. All right, so now you have your tools. Let's zoom out a bit. It's time to use them to draw a map and start to understand the bigger picture, the market trend itself.
The absolute first step is to figure out what kind of market you're even looking at. Is the price moving with a clear direction, what we call a trending market? Or is it just bouncing back and forth sideways between two levels in what we call a range-bound market? Your entire strategy is going to depend on this one distinction.
And here's what that looks like in the real world. On the left, a classic uptrend. You see how each dip, each low, is higher than the one before it? That's the textbook definition of an uptrend. And on the right, you have a downtrend, where each new peak, or high, is lower than the last one. This brings us to a super important but simple rule. 2 points on a chart can always make a line, right? But you shouldn't really trust it until a third point comes down and touches or almost touches that line. 2 points is just a guess. 3 points make a trend. But, and this is a big but, a word of warning from the pros, please don't get carried away. A chart that looks like this, just covered in conflicting lines connecting every tiny wiggle, is totally impossible to trade. It just leads to what they call analysis paralysis. Your goal here is clarity, not complexity.
Okay, so you have the tools and you have the map. But the final and honestly the most important piece of this whole puzzle, it isn't another indicator or some secret trend line. It's you.
This is something known as the hermeneutical problem. And it's really just a fancy way of saying we don't see things as they are, we see things as we are. So if you love a company, you might subconsciously just ignore all the sell signals its chart is screaming at you. Your own hopes and fears can totally cloud your judgment. So the ultimate lesson from our source material is this. You have to learn to bracket your biases. Tune out the news, tune out the talking heads, and tune out your own wishful thinking. The chart contains the sum total of all the buying and selling in the world. Learn to trust what the data is telling you.
So look, your journey into reading charts has really just begun. They speak a language of probability, of human psychology, and now you have the dictionary to start understanding them. The only question left is, what story will they tell you?
All right, let's get right into it. We're going to talk about trading today, but probably not in the way you're used to. We're not going to be breaking down charts. We're not debating indicators. Nope. Instead, we're digging into the one thing that, according to our sources, truly separates the winners from the losers, your psychology. It's this invisible battlefield inside your own head where the real money is made or lost. And here's the kicker. It has almost nothing to do with being the smartest person in the room. You know, when anyone starts trading, they're basically standing at a fork in the road. And really, over the long haul, there are only two ways this journey can go. The stats on this are, well, they're pretty brutal. The vast majority of people, even with all the best intentions and the most expensive software, end up taking the path they were trying so hard to avoid. And here are those two paths laid out plain as day. On one side, you've got this small, kind of elite group. These are the traders who pull in consistent profits. They treat it like a serious business, and they get predictable results because of it. And then you've got everyone else. The vast majority, some people say over 90%, who just consistently lose. They're on this emotional roller coaster of incredible highs and devastating lows, until eventually both their money and their confidence are just gone. This isn't just bad luck. It's something else entirely. So this brings us right to the million-dollar question, doesn't it? If it's not some secret strategy, if it's not about getting lucky, then what is it? What's the one single thing that the winners have that the losers just don't? I mean, if you could just bottle that one factor, you'd have the master key to this whole game. And believe me, the answer is probably not what you're thinking.
See, the secret sauce isn't your personality. It's not about whether you're a bold, aggressive risk taker or a slow, patient, analytical type. The material we're looking at argues that the real difference maker is something way deeper, something more fundamental to who you are as a person. It all comes down to one word: character. Let's just go ahead and bust a few myths right off the bat. You do not need a PhD in economics or an Ivy League degree to win at this game. In fact, sometimes that can actually get in your way. Your IQ, how much success you've had in business before, none of that is going to predict whether you'll make it as a trader. And why is that? It's simple. The market does not care about your resume. It's this raw, humbling force that tests something else in you entirely.
Okay, now this is the stuff that actually matters. This is the foundation. First, self-discipline. The grit to stick to your rules even when your gut is screaming at you to do the opposite. Second, taking total responsibility. No blaming the market, no blaming the news, no blaming your broker. Your results are your own, period. Third, a positive attitude toward success, a deep down belief that you actually deserve to win. Fourth, truly getting and accepting risk. This means understanding that losses are just the cost of doing business, not some personal failing. And finally, being willing to change your mind. Having the humility to say, I was wrong, and get out of a bad trade before your ego blows up your account.
And this is where that distinction between character and personality really clicks. Think of it like this. Your personality is the what. Are you an introvert, an extrovert, a big picture thinker? But character is the how. It's your internal bedrock. Your personality might influence the type of trading system you're drawn to, but it's your character that's going to determine if you can actually execute that system when the pressure is on and things get chaotic. So if building these character traits is the master key, how does that actually play out in the heat of the moment? Well, it all comes down to navigating the single biggest challenge every trader faces, that emotional storm that hits the second your real money is on the line. And the goal here is not what you see in the movies.
We all have this image in our heads, right? The great trader is this stoic, unfeeling machine, kind of like a Vulcan from Star Trek, just staring at screens, processing data, and clicking buttons without a single flicker of emotion. Well, according to the sources for this explainer, that is a complete and total myth. We're human beings. We're hardwired for emotion. You can't just turn it off.
And if you want a perfect real-world example, just look at Jim Cramer. I mean, the man is a walking, shouting bundle of emotion on TV every single night. He's passionate, he's loud. He is the polar opposite of that ice-in-the-vein stereotype. But here's the thing. Before he was a TV star, he ran a massively successful hedge fund. His emotion wasn't a bug, it was a feature. It was the fuel that kept him driven and constantly hunting for an edge.
So here's the real goal. The thing we should all be aiming for. The point isn't to get rid of your emotions. That's impossible. The point is to manage them. It's about building a system, a set of rules and disciplines so that when fear or greed inevitably show up, they don't get to grab the steering wheel. The danger isn't feeling fear, it's letting that fear make you sell at the absolute bottom. The danger isn't feeling greed, it's letting that greed convince you to throw your whole plan out the window. The legendary trader Ed Seykota, one of the original market wizards, just nailed it. He basically said that, yeah, at first, everyone focuses on the numbers and the systems, and you have to get good at that. But once you've got that down, the entire game changes. It becomes 100% a psychological battle. You're not fighting the market anymore. You're fighting yourself.
Now, the good news is you don't have to figure all this out on your own. Others have walked this path and left a map. So let's look at two absolute giants in the world of trading psychology who can give us a roadmap for building this kind of mindset. First up, you've got Mark Douglas and his classic book, Trading in the Zone. Honestly, this thing is like the Bible of trading psychology, and for good reason. Douglas doesn't give you a single trading setup. Instead, he focuses entirely on rewiring your brain to think about the market in the right way. His whole thing is getting you to deeply, truly accept uncertainty and start thinking in probabilities. Douglas says that when you get this trader's mindset, you can actually trade without fear. Not because you've become numb, but because you've accepted that you can't predict any single trade, and you just trust your edge to play out over time. And when you finally reach that zone, he says, trading stops being this stressful fight and actually starts to feel simple, even effortless. You're just executing. Our second guide is a guy named Van K. Tharp. Now, his work comes at this from a slightly different but just as powerful angle. Tharp's whole message is that there's no such thing as the best trading system out there. The only best system is the one that fits you, your personality, your beliefs, your risk tolerance, your lifestyle.
For him, it all starts with deep self-awareness. And this is probably Tharp's most profound idea. He says you think you're trading stocks or crypto or whatever, but you're not. You are trading your beliefs about them. If you believe the market is a scary rigged casino, you're going to trade that belief. If you believe it's a world of opportunity, you'll trade that one instead. And even deeper, you trade your beliefs about yourself. If deep down you don't feel like you deserve to be successful, you will unconsciously find a way to sabotage yourself every single time.
Okay, so let's say you do all this. You wrestle with the psychology, you build the discipline, you find your system. You might think you're done. But this is where our source material takes a really fascinating and honestly unexpected turn. It moves past the how of trading and starts asking a much tougher question about the why.
And there's the question, just put right out there. Is the act of short-term trading, buying and selling just for your own profit without really creating a product or a service, is that an inherently selfish, or as the source puts it, even a wicked thing to do? It's a pretty jarring question, and it's meant to make you stop and really think.
Here's the argument it lays out. Long-term investing, you could argue, has a pretty clear benefit to society. You buy a company's stock, you hold it, your money helps that company grow, hire people, and create things. But short-term trading, holding something for a few hours or minutes, does that help the company build a better widget? The argument here is no, it doesn't. Its only purpose is your own financial gain. It's an act of extraction, not creation. And look, this isn't just some abstract philosophical debate. The source points to the tragic story of Jesse Livermore, maybe the most famous trader who ever lived. He made and lost fortunes, he was an absolute legend, but his life ended in despair and tragedy. His story is this stark warning that chasing profit for its own sake can be a spiritually empty and sometimes even self-destructive path. So if we acknowledge that trading just to make money can feel kind of hollow, does that mean you just shouldn't do it? Well, not necessarily. The source suggests there's a way to reframe the entire thing, to connect what you're doing to a purpose that goes way beyond just piling up money for yourself.
And here's the proposed 3-step path to do that. Step 1 is everything we've been talking about. You have to master the craft. You develop the character, you achieve that consistent success. Step 2 is the foundation. You use that success to take care of yourself and your family, to provide security. But Step 3 is the game changer. You start to see your trading success as a tool, as a way to generate capital that you can then give away to causes that are making a real difference in the world.
And this is the final thought it leaves us with. If a trader really adopts that framework, does it change the very nature of what they're doing? If the ultimate goal isn't just personal profit, but making a philanthropic impact, could this thing that seems so self-serving on the surface actually be transformed into a powerful engine for good? Could trading, of all things, actually become a higher calling? That's the question to ponder.
Hey, welcome. Today we are jumping into 10 incredibly powerful habits. And these aren't just theories from a book. They were born from the real-world money-losing problems that traders like you and me face every single day. These are the practical rules that can literally transform your trading. So let's get right into it.
It's the million-dollar question, isn't it? So many people dive into the markets with huge hopes, only to find themselves treading water, or worse. We're all looking for that holy grail system, that one perfect setup. But what if that whole search is a distraction? What if the real secret isn't about what you trade, but how you behave, day in and day out? And that's the big idea right there. The traders who make it long-term aren't necessarily geniuses. They are masters of discipline. They've built a bedrock of habits that guides every decision, protects their precious capital, and most importantly, keeps their emotions from running the show. It's all about having a solid process, not trying to predict the future.
Okay, so let's build that process right now, from the ground up. We're going to start with the absolute fundamentals. Think of these first few habits as your non-negotiables, the strategic foundation for every single trade you even think about placing.
Our journey starts with habit number 1, and it's all built around this simple, powerful number. It's called the Rule of 3. And trust me, this is your first and best line of defense against making those impulsive, low-conviction trades that always seem to burn us. So here's how it works. You have to think like a detective building a case. One single clue just isn't enough to go on. So you see a chart pattern like a double bottom, where the price hits a low, bounces, hits it again, and looks ready to reverse. That's great, but it's just one clue. You need more evidence.
Are your momentum indicators like Stochastics also pointing up? What about the company's fundamentals? Are they solid? You need at least 3 separate, strong reasons all pointing in the same direction. That's how you stack the odds in your favor. 1 reason is a gamble, 3 is a strategy. And this quote from the investing legend Peter Lynch just nails it. If you can't sit down and clearly explain out loud exactly why you're in a trade, you're gonna panic at the first sign of trouble. The rule of 3 is how you build that deep, unshakable conviction. Now for habit number 6. Know the market trend. Think of it like a sailor checking the weather before leaving the harbor. If there's a hurricane brewing, you stay put. It's the same in trading. You wouldn't use a breakout strategy in a choppy sideways market, would you? The overall market environment dictates what kind of strategies even have a chance of working. So always ask yourself, what's the weather like today? All right, let's shift gears to what many pros will tell you is the most critical part of trading: defense. Making money is the fun part, yeah? But staying in the game to fight another day, that is everything. These next habits are all about protecting your capital. And you simply can't talk about defense without this absolute classic from the Oracle of Omaha. This is the heart of habit number 2. Keep your losses small. Look, you're going to have losing trades. It's a part of the business. The goal isn't to avoid them, it's to make sure that no single loss can ever knock you out of the market. This has to be your prime directive. So how do we actually do this? How do we put Buffett's rule into practice? It's simple, but not easy. 1. Every single trade you enter must have a predefined stop loss. No exceptions ever. 2. Before you even start trading, you need to know your maximum pain point, the most you're willing to lose in a day or a week. And 3, if your original reasons for entering the trade, your rule of 3, are gone, the trade is over. You get out. Period. Just remember, every catastrophic account blowout in history started as one small loss that got out of control. And this leads us straight to habit number 3, daily stop management. See, defense isn't a set-in-forget-it game. It's an active, daily discipline. At the end of every trading day, you need to review your winning positions. If a stock you own has made a new high, you trail your stop loss up to that new high watermark. This is how you turn paper profits into real, locked-in gains. And of course, make sure that order is good till canceled, so it's always on duty, protecting you.
And now for habit number 8, a huge one. This is a critical defensive rule. You never, ever average down on a losing position. Just look at the difference here. When a trade turns red, the amateur's emotions take over. They panic. They start throwing good money after bad, hoping it will come back. The professional? They stay calm. They stick to the plan. They let their predefined stop loss do its job, take the small, calculated loss, and move on. Averaging down isn't a strategy, it's a prayer. And hope is a terrible trading plan.
Okay, so we've got our foundation and our defense is locked in. Now we're diving into the habits that govern your actions in the heat of the moment, when the market is moving and the pressure is on. This is where your psychology really gets put to the test. Now, this brings us to habit number 5, and this is a really fascinating insight. Amateurs own the open, but the pros own the close. Think about it. The first hour or 2 of the day is often pure chaos, right? It's full of knee-jerk reactions to overnight news and big moves that fizzle out. It's called amateur hour for a reason. But the last couple of hours, that's professional time. That's when the big institutional money often shows its hand and makes the decisive moves for the day. It doesn't mean you can't trade in the morning, but it's a powerful hint that the higher quality setups often appear later on. Let's talk about a silent account killer, commissions. Habit number 4 is simple. Keep your transaction costs as low as you possibly can. I mean, just look at this chart. The difference is jaw-dropping. With just 5 trades a week, a high-cost broker can suck an extra $5,000 out of your account in a year compared to a low-cost one. That is a massive hole you have to dig out of before you even start making a profit. It's like trying to run a race with weights tied around your ankles. It's a huge self-inflicted disadvantage. And right here, this might be the single most destructive force in all of trading. Habit 9 is all about learning to conquer the demon of overtrading. It's that little voice in your head, that compulsive need to just do something, to win back a loss, to chase a stock you missed, to keep a hot streak going. Every single one of those decisions is driven by pure emotion, not by your strategy, and you know how that story ends, with sloppy trades and even bigger losses. So what's the solution? It's not just trying harder to be disciplined. That doesn't work. The solution is to build a system of rules that protects you from yourself. You have to create your own personal rule book. Set a daily profit target, and when you hit it, you're done. Shut it down and walk away a winner.
More importantly, set a maximum daily loss limit. If you hit that, you are also done. No revenge trading. And here's a key part. When you follow your rules, reward yourself. Go do something you enjoy. This reinforces the good behavior until it becomes second nature. And finally, we've arrived at the habits that truly separate the weekend warrior from the career professional. These are the long-term commitments, the things that build a sustainable, scalable trading business over time. Habit number 7 is a practice that you will find in the toolbox of nearly every trading legend you've ever heard of. You must keep a detailed trading journal. You've got to record the basics, sure, the what, when, and how much. But the absolute magic, the real secret sauce, is in that last column, the commentary. This is where you write down your why. What was your rule of 3? How were you feeling? Were you anxious? Greedy? This journal is how you become your own trading coach. It's how you spot your own bad habits and systematically work to eliminate them. And now for our 10th and final habit. And I'm willing to bet this is one you probably didn't see coming. It's a principle that's been followed by some of the greatest wealth creators in history, from the Rockefellers all the way to modern billionaires. Give a portion of your earnings away. Now, before you dismiss this, get this. There's some really interesting data here. A study by the American Enterprise Institute found a wild correlation. It turns out that for every extra $1,000 a family gives to charity one year, on average, they tend to earn an extra $3,750 the following year. Now, of course, correlation doesn't prove causation, but that's a pretty stunning and thought-provoking number, isn't it? So what's going on here? Well, whether you think it's something metaphysical or purely psychological, the principle seems to work. Sharing your success helps create a mindset of abundance, not scarcity. It reinforces the idea that money is a tool and that more will come. It can fundamentally change your entire relationship with wealth and success for the better. So as we bring it all home, what are the big takeaways from these 10 habits? It really boils down to this. Real, sustainable success is built on a repeatable process, not on lucky predictions. Playing defense is way more important than playing offense. Your personal discipline is worth more than any fancy indicator, and at the end of the day, it's your mindset, your collection of habits, that will determine your long-term results. And that leads us to the final, and by far the most important question. Because just listening to this is one thing, but actually doing something is everything. So as you look back on these 10 habits, the rule of 3, managing your stops, keeping a journal, all of them, which one of these will you commit to focusing on, starting right now, today? That choice, that first step, is where the real transformation begins. Hey everyone, the world of financial trading can feel, well, a little overwhelming, right? There are so many different strategies out there, but today we're going to cut through the noise and zoom in on one of the most popular ones, trend trading. We're going to break down what it is, how it's different from all the others, and hopefully help you figure out if it's the right fit for you. Let's dive in. But before we get into the nitty-gritty, just take a second and think about this. Where do you see yourself on the trading spectrum? Are you the type who wants to buy a stock and forget about it for 10 years? Or does the idea of fast in-and-out action get your pulse racing? Or are you looking for something in between? You see, the best strategy isn't just about making money. It's about finding a style that clicks with your own personality. Keep that in your back pocket as we go. So here's our game plan for today. We're going to start really broad, looking at the whole trading universe. Then we're going to do something kind of interesting. We're going to figure out what trend trading is by first understanding what it isn't. It's like a process of elimination that's going to lead us to a super clear definition and show us exactly where it fits in the puzzle. To really get a handle on any one strategy, you gotta see the big picture first, right? We need to understand the full spectrum of timeframes that traders work in, from years and decades all the way down to mere seconds. Okay, here we go with that process of elimination. And we're gonna start with a strategy that pretty much everyone has heard of, good old buy and hold investing. This is the classic textbook approach. The whole game here is about a company's fundamental health. You're not squinting at a daily price chart, you're digging into business plans, management teams, and market share. You're trying to find a fantastic business that you can partner with for the long haul. And the undisputed king of this world is, of course, Warren Buffett. But don't mistake buy and hold for buy and forget. This philosophy demands an incredible amount of homework. We're talking about someone who has lunch with CEOs, who walks the factory floors, who pores over financial statements for days on end before he even thinks about clicking the buy button. It is a super active, research-heavy process. So here's the bottom line. With its deep focus on a company's underlying value and a holding time measured in years, if not decades, buy and hold is pretty much the polar opposite of trend trading. Okay, one down. Let's cross that one off the list.
All right, next up we have position trading. Now we're getting a little warmer. Position traders are way more active and they absolutely care about trends. They use a mix of fundamental and technical analysis, but they have a very specific, very ambitious goal. Get in right at the birth of a new trend and ride it for several months.
And this slide nails the difference perfectly. Think of it like this. Position traders are trying to be pioneers. They're trying to predict and catch a trend right as it's being born. Trend traders? We're more like surfers. We let someone else discover the wave, we just wait for it to get good, and then we ride it. This changes the tools you use too. Position traders look at weekly charts for that long-term view, while trend traders are dialed into the daily or even hourly action.
Okay, let's shrink the timeline again. Now we're in the world of overnight trading. This is a very specific, high-intensity game. An overnight trader is trying to capture 3 separate moves: the buying pressure in the afternoon, any price gap that happens when the market is closed, and then the follow-through the next morning. It's a real sprint.
The contrast here really comes down to lifestyle. What kind of life do you want to have as a trader? Overnight trading requires you to be glued to your screen, watching every little price tick, constantly scanning for news. Trend trading, because you're holding for longer, allows for a much more relaxed approach. Often just checking in once a day is plenty.
And finally, we've arrived at the shortest end of the spectrum, day trading and its even faster cousin, scalping. The absolute ironclad rule here is you never hold a position overnight. You always go home flat, meaning you're 100% in cash. Day traders might be in a trade for a few minutes or a few hours. Scalpers, they're in and out in seconds.
So yeah, we can say with absolute certainty that trend trading is not day trading. They're playing 2 completely different games. Day traders are looking to make a whole bunch of small, quick profits from the daily market noise. Trend traders are doing the exact opposite. They make fewer trades because they're trying to capture one single major price move over days or weeks, completely ignoring all that intraday static.
All right, we've cleared the board. We've talked about all the things that trend trading is not. So now that we have that crystal clear, let's build our definition of what it actually is. This right here, this is the heart and soul of the whole philosophy. A trend trader isn't trying to be a hero. You're not trying to perfectly buy the absolute bottom and sell the absolute top. That's a fool's game. Instead, the goal is to use technical analysis, things like chart patterns and price action, to find a trend that's already up and running, ride it for the big, juicy middle part, and then hop off before it runs out of steam.
And that brings us to the magic numbers, 3 to 30 days. This is the typical holding period for a trend trade. This is that sweet spot we've been hunting for. See, it's long enough to catch a real, meaningful move and avoid getting shaken out by daily noise, but it's also short enough that you can stay flexible and react to changing markets, unlike a long-term investor who's just strapped in for the ride.
Now, this is a really, really crucial distinction. It's much better to think of trend trading not as one single rigid style, but more like a flexible toolbox. It's a set of systems and principles for finding trends and managing trades. But how you use those tools, whether you do shorter-term swing trades or longer-term ones, that's completely up to you. It all depends on your schedule, your personality, and what you're trying to achieve.
Okay, time to put it all together. Let's put everything we've talked about side by side. This is where you can really see the whole trading landscape and the light bulbs start to go off.
Just look at this table. You can see a really clear pattern, right? As you move down the list and the holding time gets shorter, the daily time commitment and the potential returns both tend to ramp up. Now, find that row for swing trend. See how it hits that unique balance? A manageable time commitment, way less than a day trader, but with potential returns that are significantly higher than the long-term folks. That's that middle ground we've been talking about, right there in black and white. So, after seeing that comparison, you're probably wondering, okay, so what's the real takeaway? What are the specific advantages, the edge, that make trend trading so attractive to so many people? So what's in it for you? Well, first off, you get the potential for higher returns, but you can do it without being chained to your computer all day long. Second, you get feedback on whether your ideas are working in a matter of weeks, not years. That is a huge deal for getting better faster. And finally, you get freedom. If the market turns ugly, you're not stuck. You can get out, protect your capital, or even use these same strategies to potentially make money on the way down.
And what's just as important is all the stuff you don't have to do. You can skip the intense financial research of an investor. You don't have to stress about the impossible task of picking the exact top or bottom of a move. And you get to sidestep the high-pressure, split-second decision-making and crazy tape-reading skills of a scalper. In a lot of ways, it's a strategy that's defined by its sheer efficiency.
So, we've defined it by what it is and what it isn't. We've stacked it up against the other styles, and we've laid out its unique advantages. And all of that brings us to the final and, frankly, the most important question of all.
Because at the end of the day, there's no such thing as the best trading strategy in the world. There is only the strategy that is best for you. So you have to ask yourself, how much time can I actually commit to this? What is my personality? Am I patient or do I need constant action? And what am I really trying to achieve with my money? Answering those questions honestly is what will lead you to the style that gives you the absolute best shot at success. So, what's your trading style going to be?
Welcome to The Explainer. Today, we are going to build something seriously powerful right from scratch. Your own personal bullish and bearish stock watch lists. This is going to be your step-by-step guide for finding the absolute best trading opportunities in what is, let's face it, a very crowded market. Okay, let's dive in.
The journey for every single trader starts with this one kind of overwhelming number. There are more than 10,000 stocks and ETFs that you could trade. It's an absolute ocean of information. And believe me, trying to watch everything at once is a surefire way to get lost. So that brings us to the big question, right? How do you possibly cut through all of that noise? How do you take this massive universe of stocks and filter it down to a list that's actually manageable? A list of stocks worth your precious time and capital? Well, that is exactly what we are going to build step by step right now. So here's our game plan. First, we'll talk about the problem. Then we'll build the foundational filters. After that, we'll craft our bullish list. And then, and this is the clever part, we'll just flip it to create a bearish list. Then we'll get practical and talk about how to adapt this for some popular screeners, and maybe most importantly, how to maintain your edge over time. This right here is the heart of the trader's dilemma. You've got thousands and thousands of options, so filtering isn't just, a nice idea. It's absolutely essential. It's how we systematically find that small handful of stocks that are actually worth paying attention to. It's all about working smarter, not harder. All right, let's get to work and start with our foundational blueprint. Before we even think about going long or short, bullish or bearish, we need to lay down 3 filters that are totally non-negotiable. Think of these as the bedrock for both of the powerful lists we're about to create. And here they are. First up, price. We're looking for stocks between $5 and $100. This helps us avoid the wild, unpredictable swings of penny stocks, but also the super slow, sluggish movement of those giant market behemoths. Second, volume. We need more than 100,000 shares traded every day. Why? To make sure we can get in and out of our trades easily. It's all about liquidity. And third, beta. We want a value over 1.5. Think of beta as a stock's volatility on steroids compared to the market. So if the S&P 500 moves up 1%, a stock with a beta of 1.5 should, in theory, move up 1.5%. This just amplifies our profit potential when the market makes a big move. Okay, our foundation is solid. Now it's time to build out our bullish watch list. We're going to add 2 really powerful fundamental filters. These are kind of like the secret ingredients that are going to put this list on steroids. Now, this is where things get really interesting. First, we're using the Zacks rank. It's a simple 1 to 5 rating system, but it has a fantastic track record for predicting stock performance. By only looking at stocks with a rank less than 4, we instantly chop off the bottom quarter of all stocks. We're getting rid of the weakest ones right away. Second, we're going to take the 50 stocks with the lowest price-to-sales ratio. This helps us zero in on companies that are potentially undervalued compared to how much revenue they're bringing in. And voila! This is what it looks like when you put it all together. We've combined our 3 foundational filters with those 2 powerful fundamental ones. What you get is a highly specific scan that's engineered to give you a super focused list of exactly 50 of the most promising bullish candidates out there.
Okay, I know what you're thinking. That's a lot of filtering. And it kind of begs the question, does this whole meticulous process actually make a difference? Is the end result really any better than, say, just picking a bunch of popular stocks?
Well, the data says, oh yeah. Just take a look at this 10-year backtest. I mean, this isn't even a full-on trading system. It's just showing the results of holding the stocks that pass our filter. On the left,
That's our strategy. On the right, the S&P 500. The stocks from our list didn't just outperform the market, they absolutely crushed it. The key number to look at is the compounded annual growth rate, 19.3% for our list versus just 8.8% for the market. It's not even close. Let me put it another way. Just look at this number, a 480.5% total return over 10 years. The S&P 500, just 131%. See, this is the power of starting with a properly filtered list. Every single stock you even bother to look at for a bullish trade has already been pre-vetted for massive outperformance.
All right, let's move to the other side of the market now. The real genius of this system is its symmetry. We don't have to go back to the drawing board to find great bearish candidates. We just take our fundamental blueprint and we invert it. It's that simple. This slide lays it out perfectly side by side. For our bearish list, we flip the Zacks rank to look for stocks with poor earnings revisions, and we flip the price to sales to find the most overvalued companies. We also bump up the price and volume requirements a little bit. That's a smart move to help reduce the risk of a short squeeze. You know, when a heavily shorted stock suddenly rockets up, higher price and volume stocks are just less likely to do that. But notice, beta stays the same. We still want that volatility. And here you have it, the completed bearish scan. It's specifically designed to find 50 stocks that are fundamentally weak, probably overvalued, basically the perfect candidates to look at for short selling opportunities.
And of course, the proof is in the back test. Now hold on, take a second to absorb these numbers. Over 10 years, the stocks from our bearish list returned only 61.3%, while the S&P 500 grew by 147.1%. Now you might think that looks like a failure, but it's actually a massive success. The whole point of a bearish watch list is to find stocks that are going to underperform the market, and our scan did exactly that.
Okay, theory is great, but let's get practical. I know not everyone uses the same fancy screening software, so let's walk through how you can adapt this entire blueprint for one of the most popular free tools out there. So if you're not using a premium service, don't even worry about it. We've got a really smart workaround that'll let you build these exact same powerful lists using the free screener over at finviz.com. So here's the setup. On the left, you've got the bullish scan in Finviz, and on the right, the bearish one. Now, since the proprietary Zacks rank isn't available there for free, we use a clever substitute, analyst recommendation. For the bullish scan, you're going to set it to buy or better. For the bearish scan, set it to hold or worse. Everything else is set up just like we talked about. But, and this is super important for all you Finviz users, there is one final check. Once your scan gives you a list and you've narrowed it down to a few top trade ideas, you've got to do this one last thing. Go to Zacks.com, type in the ticker, it's free, and just check its rank. For a bullish trade, you want to see a rank of 1, 2, or 3. For a bearish trade, you want a 3, 4, or 5. This one little extra step makes sure your free list has the same fundamental firepower as the premium one. Building the lists is a huge accomplishment. It really is. But it's not the end of the road. To really maintain your edge in the market, you have to actively manage these powerful tools you've just created. And the good news is the maintenance process is super simple. Once a month, you're just going to follow these 3 steps. First, rerun your saved scans. That'll capture all the latest market data. Second, export the new lists of about 50 stocks each. And finally, upload them into your charting software. The whole thing takes maybe 15 minutes, and it guarantees your universe of potential trades is always fresh. I just love this metaphor from the source material. Think of your watch list like a team of employees. Your job as the manager is to keep an eye on their performance, get rid of the ones that aren't working out, and bring in new, more promising candidates to take their place. Active management is absolutely key. So, there you have it. You now have the complete blueprint to build 2 incredibly powerful watch lists that give you a real statistical edge in the market. The foundation is laid, the system is built. The only question left is, who are you going to hire for your portfolio next week? Welcome to The Explainer. Today, we are going to unpack a pro-level framework that will help you trade with the market's current, instead of fighting against it. This is all about giving your strategy a massive edge by asking one simple question before you ever place a trade. So, here's what we're going to cover. First, we'll dig into why this is so critically important. Then, I'm going to walk you through the specific playbook for every market condition, bull, bear, and even that frustrating sideways chop. And we'll wrap it all up with the single biggest takeaway you can start using today.
All right, let's jump in. Okay, first things first. Let's talk about the single biggest external factor that you might be completely overlooking. And honestly, this is the one thing that can save you, even if your individual chart reading isn't quite perfect. Okay, so has this ever happened to you? I know it's happened to me. You find what looks like a perfect stock setup. Everything is absolutely textbook. You put the trade on, and poof, it just immediately fails for no reason you can see. So what's going on? What's that missing piece? Well, 9 times out of 10, it's the broader market pulling the strings behind the scenes. The legendary trader William O'Neill just nailed it with this quote. He said, trying to trade against the market is like trying to swim against a powerful tide. I mean, think about it. Even if you're the strongest swimmer in the world, that current is going to win. The best-looking stock setups get dragged under. So the huge lesson here, we have to learn how to read that tide before we even think about dipping a toe in the water. Now, the good news is this isn't as complicated as it sounds. You don't have to track, thousands of individual stocks to get the pulse of the market. We can make things way simpler by just watching a few key ETFs. For our purposes today, we're really just going to focus on the SPY that tracks the S&P 500 and the QQQ for the NASDAQ 100. Just those two give you this incredible snapshot of what the overall market is thinking. Okay, so let's jump into our first playbook. This is the fun one, right? This is for when the bulls are running the show and it feels like the wind is right at your back. So a strongly trending bull market, you know the feeling. The momentum is just undeniable. It almost feels like you can't lose, like any stock you pick is going to go up. This is without a doubt the time to be aggressive with your long positions. But, and this is a big but, you have to remember that these powerful runs can turn on a dime. And when they do, it's harsh. So you've got to stay on your toes. So how do we know for sure we're in one? Well, here's a simple 4-step checklist. Think of this as your ticket to the game. You want to see the 20-day moving average cleanly above the 50-day. You need both of them pointing up. And here's the kicker. The market is so strong that any little dip, any pullback, barely even makes it down to that faster 20-day average. And check this out. Here's a perfect picture of what I'm talking about on a real chart. See that dotted line? That's our 20-day moving average. It's just riding high above the solid 50-day line. They're both moving up, and look at the price action. Every tiny little dip gets bought up right away, bouncing right off that 20. I mean, that is a textbook definition of a strong market. Okay, now let's talk about the market we're usually in. This is the weekly trending bull market. To be honest, this is where the market hangs out most of the time. It's a lot choppier, the corrections are deeper, and it can definitely test your patience. But here's the flip side. Those deeper pullbacks, they create some of the absolute best buying opportunities with really, really good risk to reward. So what's the big difference here? It all comes down to how the price is behaving. The main trend is still up. You can see that with the 50-day moving average climbing. But the pullbacks have more teeth. Instead of bouncing off the 20, we're now looking for price to dip all the way down to that more solid support level, the 50-day moving average, before it finds its footing. And you can see it plain as day on this chart. The big picture is still trending up, right? But man, it's a much bumpier ride. Look at how the price keeps coming down to kiss that solid line, the 50 MA. For us as traders, that's exactly what we're watching for. Those tests are our potential entry signals to get long. All right, time to flip the script. Because being a great trader isn't just about knowing when to buy. It's about knowing when to play defense, or even go on offense on the short side. So let's get into the bear playbook. Now, strong bear markets. These are a different beast altogether. They are intense and they are fast. There's an old saying, markets take the stairs up and the elevator down. It's because fear is just a way more powerful emotion than greed. So while you can make money incredibly fast on the short side, you have to be so nimble. Those relief rallies can be absolutely vicious if you're not careful. So what are we looking for? Well, it's basically the exact opposite of a strong bull market, a perfect mirror image. We want the 20-day moving average below the 50-day, both of them pointing down, and any little attempt to rally gets stuffed at that 20 MA, which is now acting like a brick wall of resistance. This chart from the 2002 bear market is just classic, a textbook example. Once that downtrend really gets going, look at that dotted line, the 20 MA. It's like a ceiling that the price just cannot break through. Every single attempt to bounce gets swatted down, sold off hard, right at that level. Okay, now for the weak bear market. And just like the weak bull, this one can actually be a bit easier to trade than its strong counterpart. Why?
Because it gives you more time. The rallies are bigger, they last longer, and they push right up into key resistance zones. And that gives us these fantastic opportunities to set up short trades with a really clear risk reward.
And again, what's our guidepost? It's that 50-day moving average. The downtrend is still in force as long as that 50 MA is heading down. So our job is to be patient. We sit on our hands and wait for the price to rally all the way up to that stronger resistance level, the 50 MA, and that's where we start hunting for our short entry.
Look at this chart. You can see these rallies have some serious fight in them, right? They claw their way all the way back up to that solid 50 MA line, but then the sellers step back in and the main downtrend resumes. That area, right around the 50, that is our hunting ground.
Okay, last but not least, let's tackle the market condition that drives most traders absolutely crazy, the sideways chop, when the market is just going nowhere. We're going to break down how to handle this, and then we'll wrap it all up with the most important takeaway. So yeah, a range-bound market is a nightmare for trend followers. But you know what? For a nimble trader who knows what they're looking for, it can actually be a goldmine. You've basically got the bulls and the bears in a deadlock stalemate. Prices just ping-ponging between very clear levels of support and resistance. It is a perfect environment for playing those reversals.
And the telltale sign, the dead giveaway? A flat 50-day moving average. It's just going sideways. And the 20 MA looks like a snake, just weaving above and below it. At this point, the moving averages are pretty much useless for support or resistance. Price just cuts right through them like they're not even there.
And this chart just shows it perfectly. Look at that mess in the middle. The moving averages are all tangled up. They give you zero directional clue. The only thing that matters here is that flat 50 MA and the fact that price is trapped in a box, just bouncing between the top and the bottom like a pinball.
So let's bring it all home. If there is just one thing you remember from all of this, make it this. Figuring out what the broad market is doing isn't just some optional extra step. It is the first step. Consistently, deliberately getting yourself on the same side as the market's money flow, it's probably the single most powerful thing you can do to stack the odds in your favor.
So now it's your turn. I want you to go pull up a daily chart of the SPY or the QQQ. Use the exact rules we just went through and make the call for yourself. What kind of market are we in right now? Is it a strong bull, a weak bear? Are we stuck in the chop? Because once you can answer that question, that's when you really start to read the market like a pro.
Are you tired of chasing hype and looking for a trading strategy that's more about discipline and repeatable setups? Well, today, we're going to break down the pullback. It's a simple but really powerful technique that a ton of traders rely on day in and day out. Let's get right into the blueprint.
So here's how we're going to tackle this. First, we'll get crystal clear on what a pullback actually is. Then, we'll dive into the 3 critical indicators. These are our non-negotiable rules. After that, we'll see how to build a screen to find these stocks, look at some real charts, learn how to pick the absolute best setups, and finally, we'll look at the hard data to see how it's actually performed over time.
All right, so first things first. What is a pullback? You know, at its heart, it's a strategy that's so fundamental, so reliable, that it's actually earned a very specific nickname from traders who've been in the game a long time.
And this quote from the source material just says it all, calling it a bread and butter setup. And why is that? Well, because this isn't about trying to find some rare, super complex pattern that only shows up once a year. It's about having a go-to strategy that you can reliably look for, almost all the time. It provides a steady stream of opportunities.
Okay, and this is the most important part. We are not trying to catch a falling knife here. We are not trying to predict the absolute bottom in a stock that's crashing. This strategy is all about identifying strong stocks, ones that are already in a confirmed uptrend, but are just, taking a little breather. That dip, that little bit of weakness, that is our potential entry point.
The whole thing really plays out in 3 clear moves. I like to think of it like a sprinter. First, you've got the sprint itself. That's the strong uptrend. Second, the sprinter has to take a quick breath. That's the stock pulling back, usually to a key support level like a moving average. And third, the sprint starts again. The original uptrend kicks back in. Our entire job is to get in right as that breath is ending, just before that next sprint is about to take off.
So how do we actually spot this pattern with any kind of precision? Well, for that, we need a blueprint. And this blueprint is built on 3 key indicators. These are the non-negotiables. If even one of these is missing, it's just not a valid setup according to this system. Simple as that.
Okay, rule number 1, the big one, is super simple. The stock absolutely must be in an established uptrend. I mean, this is a trend-following strategy, right? So if there's no trend, there's nothing for us to follow.
And we don't just guess if it's in an uptrend. We define it with a really specific technical picture using moving averages. All we need to see is that the 20-day moving average is above the 50-day, and the 50-day is above the 200-day. When you see them stacked like that, it's a clear confirmation that the trend has real strength across the short, medium, and long term.
So, we've got our uptrending stock. Great. Now we need to confirm the pullback part of this setup. We need a way to measure that temporary weakness we've been talking about. And for that, we're going to turn to an indicator called stochastics. The easiest way to think about it is like a rubber band. As the stock price stretches higher and higher, that rubber band gets really tight. When the price pulls back, the band loosens up. So using these specific settings, when that stochastics line dips below 20, it's a sign that the rubber band has loosened. The stock is considered oversold compared to where it was just a little while ago.
Okay, so we found an uptrending stock that's now temporarily oversold. What's next? The final piece of the puzzle is our trigger. It's the signal that buyers are finally starting to step back in and that the pullback might be over.
And that trigger comes from looking at the daily price chart, specifically the candlestick. Now, the absolute bare minimum requirement here is a green candle. That just tells us that for that day, the buyers won the battle. The stock closed higher than it opened. It's a simple sign that buying pressure is starting to come back. Now, if you happen to see a classic bullish reversal pattern like a hammer, well, that just adds even more conviction to the whole setup.
All right, knowing the rules is one thing, but how in the world do you find these stocks when there are thousands to choose from? Let's turn this theory into practice and actually build a stock screen. So this right here, this is the exact recipe. You can take these criteria and plug them into most advanced stock screening tools. And notice how each line just translates our rules directly into code. The first 4 lines make sure we have a rising uptrend, the 5th one finds that oversold condition with stochastics, and the very last one pinpoints that green reversal candle. This is how you automate the hunt. Okay, the blueprint is complete. We have the rules. Now, let's see how this whole thing plays out on some actual stock charts from the source material. This is where the theory really becomes real. Now take a look at this. What's so amazing about this chart of Carr is just how many times this setup appeared on this one stock. Each of those numbered arrows points to a valid buy signal. Now, look down at the indicator at the bottom. You can see it clear as day. Right before each of those big upward moves, that stochastics line dipped down into that oversold area below 20. It's just a perfect illustration of the pattern repeating over and over again.
You know, this chart of BLDR is a fantastic learning tool because it proves that not all setups are created equal. Signal number 1, for example, technically it was valid, but look at the moving averages. They were kind of flat, even sloping down a bit. That makes it a much lower probability trade, one that probably would have gotten stopped out. But then look over at trades 4 and 5. By then the trend was way stronger. Both moving averages were rising steeply, and that is exactly what we want to see.
And that brings us to a really crucial point. Let's say your screen spits out a whole list of candidates. How do you choose the best of the best? Let's go over a few pro tips to help you filter for only the highest quality setups.
So how do we find those A-plus setups? Really, it all comes down to looking for signs of strength. You want to see a nice wide gap between the 20 and 50-day moving averages. That signals a really powerful trend. An orderly, shallow pullback is always better than a sudden, sharp drop. And like we just saw, you really want both of those key moving averages to be rising pretty steeply when you get the signal. These little filters can help you weed out the weaker candidates.
Okay, so we've got the theory, we've got the rules, we have the pro tips. But this all comes down to one simple question, right? What does the data say? Does this strategy actually work? What kind of performance has it historically produced?
Here we go. These are the results from a 5-year backtest, running from 2013 all the way to 2018. The test started with a hypothetical $10,000 portfolio and just mechanically applied our pullback rules. Now, don't get lost in all the numbers here. We're going to focus on the 2 that really matter most, the final profit and how it stacks up against the market.
And here it is, the headline number. The total return over that 5-year period was over 600%. Just to be clear, that means the initial $10,000 would have grown to over $70,000. It's a pretty powerful demonstration of what can happen when you consistently apply a high probability setup.
Now, to really put that 600% number in context, let's compare it directly to the benchmark, the S&P 500. During that exact same period, the pullback setup's total return was 612.5% versus just 90% for buying and holding the S&P. And if you look at it on a yearly basis, that's over 48% per year, which just blows past the index's 13.6%. Now, of course, past performance is never a guarantee of future results, but this data definitely makes a very compelling case.
So there you have it. We've broken down the definition, the 3 key indicators, the exact screening criteria, and the historical performance. The complete blueprint is now in your hands. The only question left is, how are you going to use it?
You ever see this happen? A stock is just on an absolute tear, rocketing upwards. And then suddenly, it just hits the brakes. It starts trading sideways, and you're sitting there staring at the screen wondering, okay, is the party over? Or is this my chance to get in before the next big move? Well, today we're going to dive into a powerful chart pattern that's designed to answer that exact question.
So here's the game plan. First, we're going to talk about why a simple pause in a trend can be so incredibly powerful. Then we'll get into the nitty-gritty, the anatomy of what we call a coiled spring. From there, I'll show you how to spot it in the wild with some real-world examples and, of course, how to actually make the trade. And to wrap it all up, we'll look at the performance data and I'll give you some pro tips to really stack the odds in your favor.
All right, let's set the stage. This whole idea, this entire setup, it really boils down to a problem that every single trader runs into. And that brings us to a really important question.
I mean, this is the classic scenario, right? A stock has been on fire, then it just stops. It goes quiet, trading in a tight little range. All that awesome momentum feels like it's just vanished. So, is that your cue to get out? Or is the stock just catching its breath, coiling up, and getting ready for the next massive surge higher? This pattern, this gives us a way to turn all that uncertainty into a clear, actionable game plan.
So, the answer to that dilemma is a pattern called the Coiled Spring. And you gotta love the name, right? Because like any good spring, all its power comes from that controlled tension building up just before a huge release. So let's break down exactly what we're looking for.
At its core, the coiled spring is what we call a consolidation pattern. Now, you've probably heard other names for things that look kind of similar. You know, a bull flag, a pennant, maybe a symmetrical triangle. For what we're doing here, we're basically grouping all those variations under this one really powerful setup. The idea is so simple. Strong stocks don't just go up in a straight line forever. They rally hard, and then they have to take a breather, you know? They need to digest those gains before they can continue the trend.
And what's really going on under the hood here? It's pure market psychology. This sideways chop isn't just random noise. It's a fight. It's a battle. You've got the bulls who think the stock is going way higher, buying up shares from the early investors who are taking some profits off the table. And when that tug of war happens in a really strong stock and the volatility just dries up, it's exactly like compressing a spring. You're just storing up all this kinetic energy, waiting for it to pop.
Okay, so to separate the real deals from the fakes, there are 4 rules. These are non-negotiable. First, the stock has to have shown some serious strength. It must have hit a new 3-month high within the last month or so. That proves it's already in demand. Second, the consolidation, the coil itself, needs to last between 7 and 20 days. That's long enough to build tension, but not so long that it means everyone's getting bored. Third, you have to see the range tightening up. You want to see higher lows and lower highs, creating that classic coil look. And finally, the whole pattern, the entire thing, must stay above the 50-day moving average. That's our T sign that the stock's intermediate-term uptrend is still intact.
All right, theory is one thing, but let's see what this actually looks like on a real chart. We're going to take a look at Lithia Motors, ticker LAD, and watch 2 of these setups play out one right after the other.
Okay, here it is. This is the daily chart for LAD. You can see we've got a few key moments labeled that perfectly show what we're talking about. Let's walk through this step by step.
If you look back at that chart, it all starts with that initial explosion. A stock will often bump its head against a resistance level for weeks, sometimes months. What we're looking for is a powerful, decisive punch right through that level, setting a new 3-month high. That's the initial blast of energy that tells us, hey, pay attention to me.
Now, right after that huge breakout, what happens? The stock doesn't just keep running to the moon. Instead, it pauses. In this LAD example, it formed a perfect 9-day coil. You see the trading range get tighter, volatility shrinks, the stock is just digesting that big move. This right here is the spring being coiled.
And then, after it breaks out from that first coil, what does it do? It does it all over again. On the LAD chart, after another nice rally, an even longer 15-day spring formed. And in this one, you can really see that pattern of higher lows and lower highs just squeezing the price into a fine point. It's just a beautiful example of how this setup can repeat itself in a strong stock.
Okay, so knowing how to spot the setup is half the battle, for sure. But the most critical part, the part that actually matters, is knowing the exact moment to pull the trigger. So let's use another great example here, interactive brokers, to see how that works.
And here it is, the single most important part. The buy signal is not a gut feeling. It's not a guess, it is a decisive daily close above the upper trend line that you've drawn across the top of that coil. That's the moment. When the price breaks out of that compression, the battle is over, the bulls have won, and that is your trigger to get in.
And man, this chart just drives the point home. Look at this. On this chart for interactive brokers, you see not one, not two, but 4 consecutive coiled spring setups. Every single one of them gave a crystal clear buy signal when it broke that upper trend line, and every single one led to a nice rally. And what's really cool is this also shows how you could use those later signals to add to a winning position. The trend just gets stronger with each successful pause.
Now, just as important as your buy signal, maybe even more important, is your get out signal. This is your risk management. If the stock, instead of breaking up, closes below the lower trend line of the coil, the setup is dead. It's invalidated. The pattern failed, the bears won that little battle, and you need to take that stock right off your watch list. This simple rule keeps you out of trades where the tension resolves to the downside.
So this all looks pretty great on a couple of handpicked charts, right? But the real question is, how does it actually perform over time? And are there little tricks we can use to find the absolute best of the best setups? Let's dig into the data and some expert tips.
So what do you think this number is? Well, this was the total return that was generated in a 5-year backtest of this exact strategy. Let's put that in context.
Okay, here are the results from a hypothetical backtest that was run on stocks between 2013 and 2018. It took 76 trades in total with 52 winners and 24 losers. Now, we've got to be honest here and mention the caveats, right? This test was done during a pretty strong bull market. The number of trades is kind of small, and, spotting these patterns can sometimes be a little subjective. So, past performance is never a guarantee, but this at least gives us an idea of the strategy's potential.
To really see the power here, let's put it side by side with the S&P 500 over that same 5-year period. The benchmark returned a perfectly respectable 90%, but the coiled spring strategy, it returned over 1,000%. The annualized return tells the same story, 62.7% for the strategy versus just 13.6% for the overall market. That really shows you the potential of focusing on strong stocks when they're taking a rest.
So how can you filter for the absolute A-plus setups? Here are some fantastic pro tips. First, try to favor stocks with strong fundamentals, like a low price-to-sales ratio. Next, look for a reason for that initial rally, like a huge earnings beat. It just gives the move more legitimacy. On the technical side, make sure the key moving averages are both pointed up, confirming that strong trend. You absolutely want to avoid any coils that are drooping downwards. That's a sign of weakness, not strength. And finally, a great sign is when the volume dries up during the coil. That suggests all the sellers are exhausted, making a breakout way more likely.
So, at the end of the day, the coiled spring isn't just a pattern on a chart. It's a story. It's a story of energy being stored up. It helps you find strong stocks that are just taking a healthy, necessary pause before they continue their climb. It gives you a clear set of rules, a precise entry trigger, and a well-defined exit if you're wrong. It finds the tension right before the release. The only question left is, will you be there when they spring?
All right, let's dive right in. Today, we are breaking down a really powerful tool for traders, one that's designed to help you spot market rallies before they actually take off. We're talking about the bullish divergence setup, a strategy that could help you find some of the biggest swing moves out there.
And this quote really hits the nail on the head. This isn't just about finding small incremental gains. The whole idea here is to identify the potential start of a major new move in a stock to get you in right at that critical turning point.
I mean, just think about that for a second. What if you could see, clear as day, when a stock's downward slide is finally running out of gas, right before it turns around and continues its climb? Well, that's exactly what this setup is built to do. So how on earth does it work? Well, the secret lies in a powerful reversal signal. And at its heart, it's all about this fascinating little disagreement that can happen on the charts, a clash between what the price is doing and what the momentum is really telling us.
So here's the big idea. You've got a stock, and its price falls to a new low. Now on the surface, that looks pretty bad, right? Bearish. But if you look underneath at your momentum indicators, things like RSI or MACD, they're actually making a higher low. That disagreement is the divergence. Think of it like a car rolling down a hill. The price is the car. It's still moving down. But the momentum, that's the engine. And the engine has started to sputter. The force pushing that car is dying out. And that's a huge clue that the sellers are losing their grip.
And this is a really important point. The goal here isn't to just randomly try and catch a falling knife in some stock that's in a death spiral. No way. The whole objective is to use this signal to find the bottom of a pullback, but, and this is key, within a stock that's already in a healthy long-term uptrend. We're looking to buy the dip right before it rips.
Okay, so that's the theory. Now for the fun part. Let's get practical and break down the actual blueprint. We've got a super clear 3-step checklist that you can use to spot this setup for yourself. Step 1, and listen, this is absolutely non-negotiable. Before you do anything else, you have to confirm the foundation. The stock must be in a solid, long-range uptrend. The easiest way to check this? Make sure the 50-day moving average is above the 200-day moving average. And critically, that 200-day moving average has to be rising. This tells you the stock is healthy and you're fishing in the right pond.
Okay, once that foundation is confirmed, you look for these 3 things. First, the price pulls back and dips below its 50-day moving average. Second, as it's pulling back, it makes at least 2 lows, with that second low being either lower than the first or at the same exact level. And third, and this is the magic moment, that final low in price has to line up with a higher low on at least 2 of your momentum indicators. You see all 3? Boom, you found the setup.
So what indicators should you be using? Well, here's a great toolkit to pull from. You don't need to use all of them, but you absolutely need at least 2 of them to confirm that higher low. So you might see it on the RSI and the MACD, for example. The more indicators that agree, the stronger your signal becomes.
All right, theory is one thing, but seeing this play out in the real world is where it all clicks. So now we're going to look at the anatomy of a real trade. Let's put this blueprint to the test on a couple of actual stock charts. And here they are. On the left, we've got Asbury Automotive Group, or ABG. This one shows a classic lower low pattern. And on the right, we have Wesco International, ticker WCC, which is a fantastic example because it shows 2 different setups, including a powerful double bottom pattern. Let's break them down.
Okay, let's zoom in on ABG. First things first, check the foundation. That dotted line at number 1, that's our rising 200-day moving average, and the 50-day is above it. So, check. Now look inside the box. We see a price low at 0.2, followed by an even lower low at 0.3. But here's the divergence. Look down at the indicators. The CCI at 0.4 and the RSI at 0.5 both made clear higher lows. And the result of spotting that signal? A 28% rally in just 4 weeks. Pretty incredible.
Now for our second example, WCC. And this one is so cool because we get 2 separate setups back to back on the same exact chart. It's a perfect illustration of how this pattern can show up in slightly different ways.
So let's compare them. Setup number 1 was that classic lower low pattern, just like we saw on the last chart. Price makes a low, then an even lower low, while 2 indicators make higher lows. But then look at the second setup. This time, the price made an equal low, forming what traders call a double bottom. This is often an even stronger signal, and in this case, it was confirmed by bullish divergence on 4, count them, 4 separate indicators. Needless to say, both setups led to some really nice moves.
Okay, so we've seen a classic setup and then an even more powerful double bottom version. Which kind of begs the question, right? How do you filter through all the potential setups to find only the A+ highest probability trades? Well, let's talk about sharpening your edge.
This is basically your cheat sheet for finding the best of the best. First, it helps to favor stocks with strong fundamentals, like a low price-to-sales ratio. As we just saw, that double bottom, or equal low, is often a more powerful signal than a lower low. And hey, the more indicators confirming the divergence, the better. Think of it as having more witnesses to back up your story.
Also consider the cause. A pullback happening because the entire market is weak is often a better bet than one caused by some bad news specific to that company. And finally, if both moving averages are rising, that just screams strength. So, we've come to the million-dollar question. Does this strategy actually work over time? This is where we need to look at the hard data. We've got a 5-year backtest of this very strategy, and we're going to put it head-to-head against the S&P 500. And well, the results are pretty eye-popping. Over that 5-year period, from 2013 to 2018, this bullish divergence strategy had an annualized return of 54.6%. For comparison, just buying and holding the S&P 500 over that same time would have gotten you 13.6%. I mean, this chart really says it all. And here's the full data table from that test. If you started with a hypothetical $10,000, this strategy would have grown it to over $88,000. There were 118 trades in total, and 84 of those were winners. That's a total return of a massive 783%. The numbers really do speak for themselves.
But, of course, we absolutely have to include this disclaimer. A backtest is just a look in the rearview mirror. It's a fantastic guide, and it shows what a strategy was capable of, but it is never, ever a guarantee of what's going to happen in the future. Markets change, and no strategy is perfect.
You know, if you only take one single thing away from all of this, let it be this. When you're looking at a chart and you see the price telling you one story, but the momentum indicators are telling you a completely different story, that disagreement, that's a signal, and you need to pay attention.
So, we've defined the pattern, we've walked through the checklist, we've looked at real trades, and we've crunched the numbers. The only question left is, what happens next? Now that you know what this pattern looks like, what disagreements will you start spotting on the charts you're watching? Thanks so much for joining me. Hey, welcome! Today, we're diving into something every trader has to deal with. What on earth do you do in a raging bull market? You know, when stocks just keep ripping higher and higher, and it feels like you've completely missed the boat. Well, we're going to break down a really specific, powerful strategy that's built for exactly that kind of moment. So, have you ever been in this spot? You're watching the market just climb and climb and climb, and you're sitting there patiently waiting for a little dip, you know, a pullback so you can buy on sale. But that dip, it just never comes. Meanwhile, you're seeing everyone else seemingly making a killing, and you're just stuck on the sidelines feeling pretty frustrated. It's a super common feeling in a really strong market.
Well, what if I told you there's a specific weapon for this exact scenario? There is, and it's called the blue sky breakout. It's a type of momentum strategy that's designed to do the opposite of waiting. It's designed to get you into those powerhouse stocks, instead of just hoping for a dip that might not happen for months.
So here's our game plan. First, we're going to dig a little deeper into that bull market problem. Then, we'll introduce the solution, the blue sky breakout, and break down its 5 golden rules. After that, we'll see how it actually works with some real charts, look at a few ways to fine-tune the whole thing, and finally, we'll check out the performance data. Sound good? Let's do it.
Okay, let's really set the stage. We're all taught from day one to buy the dip, right? It's good advice, most of the time. But in a seriously powerful bull run, those dips can be tiny or they just don't happen at all. If you stick only to that one strategy, you can end up sitting on your hands for weeks, maybe even months, just watching a historic rally pass you by. The blue sky breakout is the tool designed to get you off the bench and into the game when these exact conditions pop up.
So what is it exactly? Well, the blue sky breakout is a momentum trade, or a Momo trade, as you'll hear it called. And listen, this isn't some obscure technique someone cooked up last week. This is a style of trading that's been used by absolute legends, people like Richard Dennis and his famous turtle traders, William O'Neill of Investors Business Daily, even the great Jesse Livermore. It's a classic approach for strong markets. Now, the whole philosophy here basically flips what we're usually taught completely on its head. Instead of trying to buy a stock when it's on sale, the goal is to buy high and sell even higher. You're buying into strength, not weakness. In fact, this setup has been called a desert island setup. The idea is if you were stranded on an island and could only use one trading system for a bull market, this would be a top contender, just for its potential reliability.
Okay, now we're getting to the really good stuff, the heart of the system. This is not about hunches or gut feelings. The blue sky breakout is a purely mechanical system. It's built on 5 super strict, repeatable rules. If a stock checks all 5 boxes, it's a potential trade. If it misses even one, you just move on, no questions asked. Let's see what they are.
So here they are, the 5 rules at a glance. We need a new 40-day high, but and this is critical, not a new 52-week high. Then, we have to check that the stock isn't too stretched using something called a max price multiple. After that, we need confirmation from two key indicators, on-balance volume and the MACD. And finally, we need a solid green candle on the breakout day itself. Okay, let's break down each one. All right, rule number 1. We are looking for a stock that just closed at its highest price in the last 40 trading days. That's about 2 months of trading. But the really important part is the second half of the rule. It cannot be a new 52-week high. Now, why is that? Well, this is a very specific filter. It helps us find stocks that are breaking out of a recent funk or consolidation period, but they still have room to run before they hit that major year-old resistance level.
Rule number 2. Think of this as our safety valve. It's designed to stop us from chasing stocks that are already way overextended. You calculate what's called a max price multiple. You just take the closing price on the day of the breakout and you divide it by the stock's 52-week low. That number has to be 2.0 or less. So for example, if a stock's low for the year was, say, $40, a valid breakout would have to happen at a price below $80. Simple as that.
Now, before we hit Rule 3, we need a quick timeout to define a key tool here, on-balance volume, or OBV. It sounds complicated, but it's not. Just think of it as a running total of a stock's volume. On days the stock closes up, you add that day's volume to the total. On days it closes down, you subtract the volume. A rising OBV is a great sign because it suggests that the big players, the institutions, are quietly buying up shares. It's a fantastic way to confirm a price move.
And that brings us right to rule number 3. The breakout in price to that new 40-day high absolutely must be confirmed by the OBV indicator also hitting a new 40-day high. This tells us that the move has real power behind it. It's not just a random price spike, it's being driven by heavy volume and serious buying pressure. It's like the market itself is yelling, yeah, this breakout is the real deal.
For rule number 4, we want another layer of confirmation, but this time from a momentum indicator. The main MACD line, not the signal line but the MACD line itself, must also be hitting its highest point in the last 40 days. So now we know not only that there's heavy volume behind the move, but that momentum is strong and, just as importantly, it's accelerating as we break out. It's a 1-2 punch of confirmation.
And finally, rule number 5. This one is super simple but incredibly effective. The candlestick on the day of the breakout has to be green. All that means is the stock closed higher than where it opened that day. This little filter helps us avoid what traders call head fakes. You know, those situations where a stock might gap up on good news pre-market, but then it just gets sold off all day and closes weak. We want to see strength from the open to the close.
So there you have it. Those are the 5 rules. They're strict, they're mechanical, but the big question is, do they actually work? Let's stop talking theory and pull up some real-world charts to see the system in action. We'll look at a perfect example and also see how the rules can keep you out of trouble.
Okay, check this out. This is a beautiful example with a stock called Navistar. Right here at point 2, you can see the stock makes a new closing high, breaking out of that range it was in since point 1. That's our 40-day high. The price multiple rule was met too. Now look down at the indicators. At that exact same moment, the MACD at point 3 and the OBV at point 4 also hit new 40-day highs. All the rules were met. And the result? The stock ran up 65% in just 9 weeks. Just a textbook setup.
Now, this next chart is maybe even more important because it shows the system's defensive power. This is tailored brands, and you can see 4 different potential breakouts. At breakout number 1, the price and the MACD made new highs, but look at the OBV. It didn't confirm. The rules kept you out, and the stock tanked. Then at breakout 2, the OBV failed to confirm again, and the stock just went sideways. At breakout 3, it was the MACD's turn to fail. It was only at breakout number 4 that everything, and I mean everything, lined up. New price high confirmed by new highs in both the MACD at 0.5 and the OBV at 0.7. That was the real signal, and it led to a 60% gain. This is a perfect example of why you have to stick to every single rule.
Okay, so we've got the rules, and we've seen them work. But what happens if you get, say, 5 different valid signals on the same day? How do you pick the best of the best? Well, the source material gives us 5 little tiebreaker criteria to help fine-tune our choices and really zero in on the highest probability candidates. First, if you have to choose, lean towards the stocks that are cheaper from a fundamental perspective, like one with a low price-to-sales ratio. Second, favor stocks with strong ratings, like a Zacks rank of 1, which is the best. Third, try to pick breakouts that are not also breaking a 6-month high. That just means there's more room to run. Fourth, look for stocks breaking out from a nice, flat, shallow consolidation base, not one that's already gone straight up like a rocket. And finally, see if there's a real fundamental reason for the breakout, like a great earnings report or some other big news.
So, we've seen the theory, we've gone over the rules, we've looked at the charts. It all seems to make a lot of sense. But, the ultimate question for any trading system is always the same. What were the results? And because this system is totally mechanical, we can actually backtest it and get a really clear picture of how it performed historically. The source gave us a 5-year backtest. And importantly, it was during a period that was a pretty strong bull market, which is exactly the kind of weather this system was built for. So, how did it do? Here are the numbers. Over that 5-year stretch, from 2013 to 2018, a hypothetical $10,000 account grew to over $178,000. That's a total return of more than 1,600%. Now, obviously, and this is super important, past performance is never, ever a guarantee of future results. But this data gives us a pretty powerful look at what this system was capable of in the right market conditions.
And just to put that performance into perspective, let's look at the annualized returns. The Blue Sky setup came in at 77.1% per year. During that same time, just buying and holding the S&P 500 would have gotten you 13.6%. I mean, it's a really stark comparison, and it just highlights how effective a specialized tool can be when you use it in the exact market it was designed for.
The biggest takeaway here is that the Blue Sky Breakout is not a strategy you use all the time. It's a specialist tool. It's designed for one specific job, to capitalize on strong bull markets when a lot of other strategies just don't work. It takes a ton of discipline, and you have to stick to the rules religiously. But as the data suggests, when the conditions are just right, it can be an unbelievably powerful weapon to have. So the question to ask yourself is this desert island setup the right kind of tool for your arsenal?
What if you could find a stock that's hit absolute rock bottom and get in right before it goes on a massive run? I know, it sounds like the holy grail of trading, doesn't it? Well, today, we're going to break down a strategy that tries to do exactly that. This is our explainer on the bullish base breakout.
Okay, just look at that number for a second. 5,071.7%. Nope, not a typo. That's the mind-blowing return this strategy cranked out in a 5-year backtest. It kind of gives you a hint of the explosive power we're about to get into. So let's just dive right in.
I mean, this is the question that keeps traders up at night, right? We all want to buy low and sell high, but we also know it's incredibly hard to pull off. This setup, though, it gives us a systematic blueprint for doing just that, for finding that exact moment a beaten-down stock is quietly getting ready for a huge comeback.
And that gets us to the whole philosophy behind this thing. See, we're not chasing stocks that are already flying high. We're actually doing the complete opposite. This is a contrarian play, which means we are deliberately looking to buy into weakness. We're stepping in when everyone else is scared, betting on a turnaround that almost nobody else sees coming yet.
So what is this setup exactly? Well, at its heart, it's a specific chart pattern. We're basically hunting for stocks that have been in a long, painful downtrend, but have finally stopped falling. They start moving sideways, building what we call a base. Our job is to use a couple of key tools to figure out the precise moment that base is about to turn into a launch pad for a brand new uptrend. To really get it, it helps to compare it to what most people do. Momentum traders, they're like surfers, right? They're trying to catch a big wave that's already formed and moving. We're more like deep-sea explorers, scanning the quiet ocean floor, looking for the deep currents that are about to create the next big wave. We're buying that period of calm, anticipating the future storm of buying.
Now hang on, here's a super important warning that comes with this strategy. This is not for beginners. It takes a really sharp, experienced eye because it's pretty subjective. So if you're just starting out, this is something you should study, not something you should try and trade tomorrow. The author gives one simple, brilliant piece of advice for everyone. If there is any doubt, stay out.
Okay, let's get into the nitty-gritty. What are we actually looking for on a chart? What does this bullish base really look like? This is where those chart reading skills we just talked about get put to the test. So there's a clear sequence here. Step 1, the stock has to have been in a solid downtrend for at least 3 months. That's non-negotiable. Step 2, the stock finally stops making new lows and starts to just chop around sideways. That's the base forming. And then step 3, once that base starts to appear, we kick off our observation period. at least 6 weeks where we just watch and we wait.
Okay, this slide is perfect because it shows you what to look for and what to run away from. On the left, you've got 3 valid patterns: a falling wedge, an expanding triangle, and a triple bottom. See, other trend lines are either flat or pointing down? That's key. Now look to the right. That's the imposter, the bearish rising wedge. Both of its lines point up, and that pattern almost always ends in another leg down. Avoid it.
Let's just hammer these rules home because they are absolutely critical. Rule 1. Both the top and bottom lines of your base have to be either flat or pointing down. Rule 2. No upsloping trend lines. I mean it, none. That's a sign of a bearish pattern, not the bullish one we're after. And Rule 3. The base has to have been forming for at least 30 trading days, which is roughly 6 weeks.
So, finding a potential base, that's really just the start. A nice-looking pattern isn't enough on its own. We need proof that something real is changing under the surface. And that's where our confirmation checklist comes in. This is kind of the secret sauce that tells us if a base is actually getting ready to launch. So how do we get that proof? We use 2 specific tools, the MACD indicator and on-balance volume, or OBV. Think of them as 2 different detectives on the same case. MACD tells us about momentum. Is the selling pressure finally getting tired? And OBV tells us about volume. Are the big institutions, the so-called smart money, quietly buying up shares while everyone else is still freaking out?
Here is the exact playbook, step by step. First, you find a stock that's been in a long downtrend and has formed a valid base for at least 6 weeks. Check. Next, you look down at your MACD indicator. It has to be rising while the stock price is flat. That's a huge clue that the sellers are losing steam. And finally, you look at your OBV. You draw a little trend line over its recent peaks, and you wait for it to pop above that line. That's the signal that big buyers are stepping in.
Now, what's really cool about the entry signal is how subtle it is. The actual buy signal comes on the first day the stock closes green, a green candle, after all 3 of those conditions are met. Notice what's happening here. This often happens while the stock is still trading inside the base, way before the big, obvious breakout that gets everyone else excited. We're sneaking in early.
All right, theory's great, but seeing is believing. Let's take a look at this setup in the real world. We're going to check out 2 case studies that show just how insanely powerful these breakouts can be when everything lines up just right.
Get ready for this first one, because this quote says it all. A single trade using this exact setup that shot up 155% in just 10 weeks. Let's pull up the chart and see exactly how it unfolded.
And here it is, the chart for US Steel. This is just a textbook example. Follow along with me. At number 1, you see that long, brutal downtrend. Then, at number 2, the price action goes flat. It builds a nice, clean base for more than 6 weeks. Now look down at the indicators. At number 3, during that same time, you see the MACD is clearly rising. That's our momentum shift. Then, at number 4, boom, the OBV breaks out above its trend line. That's the final confirmation and the buy signal. And you can see what happened next at number 5, just an absolute monster rally.
Here's another fantastic example from Genco Solar, and it shows a different type of base. At number 1, we've got our downtrend. Then at number 3, you can see the price forms an expanding triangle base. So how did we know this one was bullish? Well, look really closely at number 4. While the stock price made a slightly lower low inside that base, the MACD made a higher low. That is a classic, powerful bullish signal. Then at number 5, the OBV confirms it with a breakout. The result, at number 6, a quick 80% gain.
Okay, so you've seen the pattern, and you know the confirmation checklist. Now for the final piece of the puzzle. How do you refine this? How do you tilt the odds even more in your favor? This part is all about the pro tips and the hard data that backs this strategy up.
Let's say you find a few different stocks all showing this setup at the same time. Here are 4 tiebreakers to help you pick the absolute best one. First, lean towards stocks with a low price-to-sales ratio. That's a good sign of value. Second, look for a low Zacks rank, which hints at strong fundamentals. Third, longer bases often lead to bigger moves, so give the edge to the one that's been consolidating for the longest time. And fourth, find the stock that's fallen the furthest from its 52-week high. Those are often the ones that bounce back the hardest.
And that brings us right back to where we started, with the numbers. Here's the data from that 5-year backtest. A hypothetical $10,000 account would have grown to over $500,000. That's a total return of over 5,000%. Just for perspective, the S&P 500 returned 90% in that same time frame.
Now, to be clear, the author notes this was tested manually on a small group of stocks, so it's not a perfect scientific study, but wow, those results are pretty hard to ignore.
And of course, you knew this was coming. Anytime we talk about incredible returns, we have to throw in this major reality check. No matter how good a strategy looks in the past, it is never, ever a guarantee of what's going to happen in the future. Markets change, and any system is going to have its wins and its losses.
So we're going to end with the same piece of advice from the beginning, because it's the most important rule for this entire setup. It takes a skill of eye. It's subjective. If a chart doesn't look absolutely perfect, if you're not sure about the MACD or the OBV, if you feel any hesitation at all, the best trade you can make is no trade at all. Discipline is everything here.
So there you have it, the full blueprint for the bullish base breakout. It's a contrarian's dream for trying to catch a stock right at the start of a new, powerful uptrend. We've gone through the pattern, the confirmation checklist, and the performance. The only question left is, now that you know what to look for, will you have the patience and the skill to spot the next big one before it leaves the station?
All right, today we're going to demystify a trading strategy that, let's be honest, can seem pretty confusing. I'm talking about short selling. We're going to break down exactly how it works and how you can actually profit when a stock's price goes down, even if you don't own a single share to begin with.
I mean, just think about it for a second. Most of the time, investing is all about that classic mantra, right? Buy low, sell high. But what happens when you think a company's heading for a downturn or the whole market is trending down? Well, this is where short selling comes in. It completely flips that script. It's a powerful tool that gives you a way to potentially make money from a stock's decline.
So here's our game plan for this explainer. First, we'll tackle the core concept, how you can sell something you don't even own. Then we'll get into the risks and, the myths surrounding shorting. After that, we'll cover the one key thing you absolutely need, a margin account. Then we'll walk through a real-world example, step by step. And finally, we'll wrap it all up with the essential rules of the short game.
All right, let's dive right into section 1. This is the big idea. And I'll admit, it can feel kind of backward at first. Selling what you don't own? How on earth is that even possible? Well, let's break it down.
So here's the definition in a nutshell. Short selling is literally just a normal trade, but in reverse. Seriously. Instead of buy first, then sell, you sell first, then buy. You open your position by selling, and you close it later by buying those shares back. And the goal? It's super simple. Sell high, buy back low, and you get to keep the difference.
And here is the secret sauce, the thing that makes this whole thing possible. You're not selling your shares because you don't have any. You are borrowing them from your broker. See, most big brokerage firms have this massive inventory of shares from their other clients, and they keep them around for this exact reason. They lend the shares to you, you go sell them on the market, and then, later on, you buy them back to return them to the broker. Simple as that.
Okay, next up, we absolutely have to talk about the elephant in the room here, and that is the risk. You've probably heard it a million times, that short selling is just incredibly, incredibly dangerous. So let's just tackle that idea head on. So this right here, this is the classic argument you'll always hear against shorting. Think about it. When you buy a stock, the absolute most you can lose is what you paid for it, right? The price can only go down to zero. But when you short a stock, well, what's the highest a stock price can go? There's no ceiling. It could theoretically just keep rising forever, and that means your potential losses are, technically, unlimited. It's a scary thought, for sure, but we need to put it into perspective.
Yeah, but that whole infinite risk idea, it really needs some context. First off, any smart trader is going to use defensive position management. Things like stop losses to keep any potential losses small. Secondly, your broker isn't just going to sit back and watch your account get wiped out. They'll issue something called a margin call and basically force you to close your position before things get too out of hand. And let's be realistic here. Way more companies go bankrupt and have their stocks go to zero than soar to infinity. The truth is, with the right system in place, short selling can actually have a really high success rate.
There's also this whole ethical debate around short selling. On one side, you have people who say it's just wrong, maybe even un-American, to bet against a company's success. But on the other side, the argument is that short sellers provide something absolutely essential, market liquidity. For every buyer, there has to be a seller, right? Short sellers help fill that role and can even help prevent wild market bubbles. It's also worth noting, by shorting a stock, you're basically making a promise to buy that stock back in the future. So in a weird way, you're creating a floor of future demand.
Okay, so you get the concept, you understand the risks. The big question is, how do you actually do it? Well, this brings us to the single most important tool you need in your toolkit. I'm talking about a margin account.
Let me be super clear. Without one of these, you just can't short a stock, period. So what's the difference? It's actually pretty simple. A standard cash account is exactly what it sounds like. You can only trade with the cash you actually have in the account. A margin account, though, is different. It's basically an account where your broker has given you the green light to borrow from them. And that could mean borrowing money or, and this is the crucial part for us, borrowing shares to sell short. Now, the number one benefit of having a margin account, besides being able to short stocks, of course, is something called leverage. In simple terms, leverage means you can control way more stock than what you have in cash. It's like it amplifies your trading power.
Let's make this real. Imagine you have, say, $50,000 of your own cash sitting in your account. Now, with a margin account, your broker's going to give you buying power that's way more than that 50 grand.
Which means that $50,000 in cash can actually let you control $100,000 in stock positions. This can literally double your potential rate of return. Now, of course, and this is super important, it also doubles your potential losses. Leverage is a double-edged sword, and you've got to use it wisely.
But as they say, there's no such thing as a free lunch. The downside of using your broker's money is, you guessed it, you have to pay interest on it. But here's a key point. You only pay interest on the money or shares you actually borrow for a trade. So if you have a margin account, but you never borrow anything, you just trade with your own cash and you never short a stock, you won't pay a single penny in interest.
All right, now for the main event. Let's get practical and do a step-by-step walkthrough. We're going to use a stock everyone knows, Apple, to see exactly how a short trade works from beginning to end.
Okay, so let's say you've done your research and you think Apple stock is about to drop. You go to your trading platform, and instead of clicking that big green buy button, you click sell. And here's the cool part. The platform is smart. It knows you don't own any Apple shares, so it automatically understands this has to be a sell short order. The system does all the hard work for you, borrowing the shares behind the scenes.
So boom, your order goes through. Here's what just happened. You sold 100 shares of Apple at $189.85 a share. A credit for $18,985 then shows up in your account. But, and this is key, that money isn't really yours yet. Think of it like a loan from your broker that represents the value of the shares you just borrowed. Your entire goal now is to pay back that loan for less than what you just got. So let's play this out and look at two different ways this could go. First, the profit scenario. Let's say you were right and Apple stock falls down to $150 a share. You can then buy back those 100 shares for just $15,000. You use that to pay back the broker, and you get to keep the difference, a nice profit of about $3,950. Now the loss scenario. What if you were wrong and the stock actually rallies up to $210? Well, now you have to buy the shares back for $21,000, which means you've got a loss on your hands of about $2,050.
Okay, so let's just boil this whole thing down to 5 easy steps. Step 1. Find a stock you think is going to fall. Step 2. Check with your broker to make sure they have shares you can borrow. Step 3. Place that sell order to open your position. Step 4. You wait for the stock to move. And Step 5. You buy the shares back to close out your position and return them. That's really the whole process.
All right, last section. Let's cover some of the really important rules you have to know. Short selling isn't some kind of Wild West free-for-all. There are specific regulations you've got to be aware of before you even think about placing a trade.
So here are the big ones you need to remember. First, you usually can't short a stock right after its IPO. It's also off-limits for most penny stocks, the ones that don't trade very much. There's also a rule that can temporarily halt short selling on a stock if it drops more than 10% in one day. Now, this next one is really important. If the company you're shorting pays out a dividend while you have your position open, you have to pay that dividend to the person you borrowed the shares from. And finally, you absolutely cannot short stocks inside a retirement account like an IRA or a 401k.
And really, all of this brings us to the key takeaway. Look, like any powerful tool, short selling has to be handled with respect and care. This isn't about just recklessly gambling and hoping a stock goes down. It's all about having a system, managing your risk carefully, and executing a plan you've actually thought through. And when you do that, the potential rewards can definitely be worth it.
So we've gone through the mechanics, the risks, the rules, the whole shebang. Now that you know how it all works, what do you think? Is short selling a necessary tool that helps keep the market efficient and prices honest? Or is it just a super risky gamble that does more harm than good? The real answer probably lies somewhere in the middle, and it really all depends on the person using the tool.
All right, let's get right into it. Today we're going to break down a really powerful, systematic trading setup for shorting stocks that are already in a downtrend. You know, this is a professional-grade strategy, but the rules are so clear, so methodical, that anyone can learn to spot it. We're going to decode what's called the relief rally.
I love this quote from the source material. It just puts it perfectly. The strategy we're about to dive into, it's designed to, well, to supercharge your results. It's not for every stock out there, but when you apply it to the right kind of fundamentally weak companies, it's like flooring the accelerator. So yeah, let's engage ludicrous mode. Okay, before we even think about looking at a single chart pattern, we have to start at the beginning, the foundation. This entire strategy, and I mean all of it, hinges on one absolutely critical first step. Skipping this is the biggest mistake you can make. It all begins with the right watch list.
And here it is, the secret weapon. The success of this setup doesn't come from just reading charts. It comes from applying that chart reading skill to a pre-filtered list of stocks that are already fundamentally weak. We're talking about companies that are overvalued or that consistently disappoint on their earnings. This is your hunting ground. It stacks the odds in your favor before you even place a single trade.
So now we get to the core idea. The relief rally is what the source author calls a bread and butter setup. And I think that's the perfect way to describe it. It's common, it's repeatable, and it's a real workhorse for anyone trading on the bearish side. So what's the anatomy of this thing?
It's really just a simple three-act play. Act 1, you've got a stock that's already weak, it's in a clear downtrend. Act 2, you get a little bounce, a short-term relief rally where the price pops up for a bit. It's just snapping back to the average. And then, Act 3, that rally runs out of steam, hits a ceiling, and the main downtrend takes over again. Our whole goal here is to jump in and profit from that third move, the big one, down.
And let's be crystal clear on what we're looking for. A downtrending stock isn't just a stock that had a bad day. We're talking about a stock that is consistently making lower highs. And technically, we define this as a stock where the 20-day moving average is trading below the 50-day moving average. And this is crucial, both of those averages need to be pointing downwards. That tells you the trend is real and has momentum.
Okay, so we've found our weak stock. It's in a downtrend. But how do we know exactly when to pull the trigger? This is where the system gets beautifully precise. We're going to walk through the 4 specific signals, the rules of engagement, that have to be met for this to be a valid setup.
Signal number 1 is the relief rally itself. We need to see that price climb back up and touch a key moving average, which we now expect to act as a ceiling or resistance. For the really weak stocks, we're watching the 20-day moving average. For others, it might be the 50-day. And here's a key detail. We want to see a gradual climb, not a sudden, sharp, one-day spike up. A slow drift upwards is what we're looking for.
Second, we need confirmation that this little rally is running out of gas. For that, we turn to an indicator called Stochastics. You can just think of it like a momentum gauge. When its reading gets above the 80 line, that's a signal that the stock is overbought in the short term. The buyers are probably getting tired, and the stock is vulnerable to rolling back over.
And finally, we need the price itself to give us the green light. Well, actually in this case, the red light. The price candle for the day must be bearish, meaning the stock closed lower than it opened. This is so important. We don't jump the gun just because the price touched an average. We wait for this confirmation. And hey, if that red candle happens to form a classic bearish pattern, even better. This is our trigger.
All right, enough theory. What does this actually look like in the real world, right? Let's jump into some charts and see how these rules all come together to create some pretty incredible trading opportunities.
So here's a chart of Bluebird Bio, ticker BLUE. First, notice points 1 and 2. This is where the shorter-term trend, the 20-day average, crosses below the longer-term 50-day. Once that happens and the 50-day itself starts pointing down, that's a huge signal that the bears are in charge. This is the moment we put this stock on our radar and start hunting for those relief rallies.
And now, just look what happens after that. This one stock gave us a sequence of 7 valid setups. You can see the entry points marked at 3, 4, and then 6 through 9. Each time the stock rallied up, got overbought, and gave us that bearish candle to enter. And this shows you the potential. That trade at number 4, that one alone produced a 35% gain in just 7 trading days. Amazing.
Let's look at another one. This is Freshpet, ticker FRPT. After the bearish cross at point 1, we get our first clean setup at point 3. But the real star of the show is trade number 4. The source author calls this one a whopper, and you can see why.
After the signal, the stock just collapsed from over 18 bucks down to 10. That's a potential return of over 44%.
And it just kept on giving. Trades at points 5, 6, 7, and 8 all caught the next waves down. All told, the total potential profits from this one stock over about 8 months were a staggering 154%. This is what happens when you find a truly weak stock and just keep applying a disciplined set of rules.
Okay, so we know how to spot the setup, but in trading, you always want to find the A-plus opportunities, right? So how do we filter the good setups from the truly great ones? Well, the source material gives us a few extra layers of analysis to really boost our odds. Here are a few pro tips to fine-tune your search. First, go after the stocks that are the most fundamentally weak. Look for companies with super high price-to-sales ratios, a sign they're way overvalued, or the ones with the worst analyst ratings. Then, on the technical side, stay away from any setup where that rally was caused by a violent one-day price gap. And finally, the best signals are the ones that happen super close to that downsloping 20-day average. These filters just help you focus on the highest probability trades. So, the big question, does this thing actually work? We've seen a couple of great charts. What about the system as a whole over time? Let's look at the performance from a 5-year backtest. The total return was 582.2%. Yeah, just let that sink in for a sec. And here's the full breakdown of how that happened. Starting with just 10 grand, the system grew to over $68,000. It took 476 trades. 280 were winners, 196 were losers. And what's so important to see here is that you don't have to win every single time. A good system with a solid win rate where your big wins more than cover your small losses, that can be incredibly powerful. But this is where it gets really mind-blowing, when we compare it to the overall market. During that same 5-year period, which, by the way, was mostly a bull market, the S&P 500 returned a very respectable 90%. But this bearish system, trading only on the short side, returned 582%. An annualized return of 46% versus the market's 13%. That just shows you the power of combining a great technical setup with a fundamental edge. Which really brings us to our final thought. Most investors, they fear bear markets. They see falling prices, and they only think about risk and loss. But with a systematic, rule-based approach like this one, your entire perspective can shift. So the question I'll leave you with is this. In a falling market, where everyone else sees risk, could this be how you learn to see opportunity? Welcome to The Explainer. Today, we're diving into a really fascinating, almost counterintuitive trading strategy. It's called the gap-down setup, and it's all about finding a huge opportunity right at the moment a stock that everybody loves suddenly takes a nosedive. So let's get right into how it all works.
So I want you to picture this for a second. There's a stock you've been watching, and it has just been on an absolute tear for months. And then, out of nowhere, bam, it plummets on some bad news. Now, what's your first instinct? For a lot of people, it's to buy the dip, right? But here's the thing. There's another way to play this, a completely contrarian move. Instead of betting on a quick recovery, what if you could profit from that downward momentum itself? That's the wild idea we're exploring. You know, at its very core, the gap-down setup is really all about going against the crowd. It's a very specific pattern for shorting a stock. And of course, that just means betting its price is going to fall right after it stumbles from a position of real strength. We're not trying to follow the trend here, we're betting on its reversal.
And this really requires a crucial shift in your mindset. We are not trying to predict some kind of long-term collapse of a company. Nope, the goal is much more surgical than that. We're on the hunt for a fundamentally strong stock that's just been rocked by some bad news. This creates a short-term panic as all the early investors rush to lock in their profits. And that panic? Well, that is our window of opportunity.
Now, this might sound a little weird, but this bearish strategy, it actually works best in a bullish or even a sideways market. And you might ask, why is that? Well, think about it. When the overall market is strong, investors have tons of other winning stocks they can jump into. So if one of their high flyers suddenly gets hit with bad news, they don't stick around hoping for a rebound. They sell immediately to move their money somewhere else. And that is what creates the exact rush to the exits that we need for this setup.
Yeah, this quote just nails the psychology perfectly. That rush to the exits, that's the fuel for this whole trade. But you know, in today's markets, that rush happens literally at the speed of light. And that brings us to a really critical challenge for the setup. See, it used to be a lot more common to see these big price gaps right when the market opened. But today, Today we have high-frequency trading algorithms, and these things are specifically built to spot and close those gaps in milliseconds. So what does that mean for us? It means a true unfilled gap is a much, much rarer event. But, and this is the important part, it also means that when one does manage to break through that algorithmic wall, it's a much stronger and way more meaningful signal.
And the numbers here are pretty stark. Just look at this. HFT's share of market volume has more than doubled. This absolute flood of algorithmic trading means that to successfully use this setup, we can't just guess. We can't wing it. We have to be incredibly disciplined and follow a very, very precise blueprint.
So what is that blueprint? Well, it turns out there are 4 key signals that absolutely must appear, and in sequence, to confirm a valid gap-down setup. Let's walk through each one of them right now. Okay, this is it. This is your 4-point checklist, and every single one of these boxes has to be ticked, no exceptions. First, you need a steady uptrend. The stock has to have been doing well. Second, a significant unfilled gap down. Third, there has to be a specific bad news catalyst. And fourth, the day has to close with a red candlestick, which simply means the stock closed lower than it opened, confirming that the sellers were completely in charge.
Now, the definition of an unfilled gap is super precise, and for a very good reason. The highest price the stock hits all day, it has to still be at least 1% below the lowest price of the day before. This rule is what filters out all the minor morning jitters and confirms we're seeing a truly decisive, powerful break from the trend.
The catalyst is also absolutely critical. The gap can't just be random, and it can't be because the whole market is having a bad day. No, it has to be triggered by company-specific negative news. Things like a bad earnings report, a product recall, or maybe a lowered forecast. These are ideal because they give investors a very concrete reason to sell, and that's what fuels that rush to the exits we've been talking about.
And there you have it. It's really that simple. Once you've confirmed the uptrend, the unfilled gap, the bad news catalyst, and the red candlestick, the setup is complete. A sell-short signal is triggered. A trader could then enter that position either at the close of that trading day or right at the open of the very next day.
Okay, so theory is one thing, but let's see how this whole thing plays out in the real world. We're going to look at 2 case studies taken directly from the source material to see this exact pattern in action on actual stock charts. So our first case study is Alibaba. As you can see right here on the chart, the stock was in a really strong, steep uptrend, which is marked as number 1. Then, weak earnings. The company reports and it triggers that huge gap down you see at number 2. After that signal, the stock just continued to fall, offering a potential 13% gain for a short seller who knew how to spot this pattern.
And here's another great example with Editas Medicine. Again, we see that clear uptrend at number 1, followed by a panic-inducing gap down at number 2 that was caused by negative news. I mean, this was a textbook setup, and the decline that followed offered a potential 17% profit in just 5 trading days.
So now you can spot the basic setup, but how do you separate just a good setup from a truly great one? Let's look at a few extra filters, again from the source material, that can really help you identify the A-plus candidates. You can think of these factors as odds enhancers. A super high price-to-sales ratio? That suggests the stock is already priced for absolute perfection, making it extremely vulnerable to any bad news. A rally that's gone almost vertical, more than 45 degrees? That means it's overbought and totally due for a correction. And being way, way above its 50-day moving average is another big technical sign that it's overextended. A stock that has all these characteristics is a prime candidate for a really sharp, fast drop.
All right, so we've seen the theory, and we've seen a couple of perfect examples. But how does this strategy actually hold up over hundreds of trades? Let's take a look at the hard numbers from a 5-year backtest that was conducted on this setup.
Now, it's really important to understand the context of this test, okay? It was run during a 5-year period that was mostly a bull market, which, as we already talked about, is the ideal environment for this kind of setup. Also, a key limitation to remember is that the backtest couldn't automatically screen for the bad news catalyst, something a human trader obviously would. This just means that real-world results could potentially be different. Okay, here are the results. This table shows how a portfolio that only traded this setup performed against the benchmarked S&P 500 over that 5-year window. Now, there's a lot of data here, but let's just zero in on the 2 numbers that really matter the most.
First up, the annualized return. The gap-down setup strategy returned an average of 46.2% per year. The S&P 500? It returned 13.6% over the same period. I mean, that is an outperformance of more than 3 to 1. That's pretty remarkable.
And that incredible annualized return led to this. A total return of 577% over 5 years. Let's put that in perspective. A hypothetical $20,000 account would have grown to over $67,000. It's just a really powerful demonstration of what can happen when you have a disciplined strategy for capitalizing on these rare but high-probability events.
So I think the key takeaway here is that a rules-based system can turn what most people just see as fear and panic into a structured, real opportunity. This setup gives you a clear blueprint for acting decisively when everybody else is selling indiscriminately. So the question isn't just about how we view volatility, it's this. The next time a market favorite stumbles, are you going to see it as a threat or are you going to see it as a signal?
All right, let's get right into it. Today, we are going to break down a really interesting trading setup. It's all about helping you spot when a stock's big rally might be secretly running out of steam, giving you a potential heads up before things turn south. Let's dive in.
You've probably been there, right? You're in a stock that's on a tear, and you're just worried about holding on for a little too long right before it all comes crashing down. So the big question is, are there clues? Can you actually see that a rally is getting weak before the price takes a nosedive? Well, the source material says yes. And the secret is this kind of hidden conversation that's happening on the charts, a little disagreement between what the price is doing and what the momentum is telling us. So let's just lay out the problem here. You see a stock, it's been climbing, hitting new highs. On the surface, everything looks great. But how can you really tell if that upward push is the real deal, or if it's secretly just fizzling out, getting ready for a big drop?
And this, right here, is the absolute heart of it. It's this conflict, this contradiction that's playing out right in front of you. The price chart is yelling, "We're going to the moon." But the engine that's actually driving that price, the momentum, is quietly whispering a totally different story. That little whisper, that's the divergence that we're looking for.
Okay, so let's put a name to it. Bearish divergence. Think of it as a disagreement right on your chart. The stock's price hits a new peak, which looks awesome. But, and this is the important part, the momentum indicators, tools like RSI, which measures the speed of price changes, or the CCI, which is great for spotting trends, they don't follow along. They actually post a lower high. It's an incredible clue that the buying pressure is secretly getting weaker, even while the price is still ticking up. So how do we actually find this, and more importantly, make sure it's a real signal and not just noise? Well, the source lays it all out like a simple 3-step recipe. This isn't about gut feelings, it's a very specific checklist, and you need all the ingredients for this thing to work. Let's break it down. First things first, before we even start looking for the divergence, we have to get the context right. The entire foundation for this setup is that the stock is already in a long-term downtrend. And the easiest way to check this? Just see if its 50-day moving average is trading below a falling 200-day moving average. This is so crucial because it tells us that any rally we're seeing is probably just a temporary bounce inside of a much bigger downward trend. Okay, here it is, the whole recipe on one slide. Step 1, we just covered it. Confirm that long-range downtrend. Check. Step 2, you look at the price itself. Has it rallied up and made at least 2 peaks where the second one is either higher than or at least equal to the first one? If it has, you move on to the last and most important step. As the price is making that second peak, you glance down at your momentum indicators. Are at least 2 of them, like the RSI or the MACD, making a lower peak? If you can tick all 3 of those boxes, boom, you've got a valid bearish divergence setup. Now, theory is one thing, but seeing this play out in the real world is where it all clicks. Now that we have our recipe, let's go look at a couple of real-world chart examples from the source material. This is where the concept really comes to life. Okay, our first case study is Workday, the software company, ticker WDA. The source points out that even though it's a solid company, it can have these really sharp sell-offs, which actually makes it a pretty good candidate to watch for a setup just like this. Okay, take a look at this chart. It is a picture-perfect example of the setup. See that number 1 up top? You can see the price made 2 highs at pretty much the exact same level. But now, look down below the price chart. And number 2, the CCI indicator, it made a clear pattern of lower highs. And it's the same story for the RSI at number 3. So the price was basically going nowhere, but the momentum, the energy was just draining out. That's the divergence. That was the signal. And what was the result of spotting that signal? Well, according to the source, this setup happened right before a move that offered a potential gain of a whopping 43.4% in about 2 months. So the takeaway here is, this little disagreement on the chart, it wasn't just some minor detail. It was a huge warning sign of what was about to happen.
Let's do one more just to make sure this concept is locked in. This time, we're looking at Antero Midstream Partners, ticker AM. The source calls this one a classic example of the setup, so let's see why. And this chart is just fantastic because it shows the other way this can look. Up at number 1, you can see the price didn't just make an equal high, it actually made a higher high. So on the surface, it looked even more bullish. But again, look below. The CCI at number 2 and the RSI at number 3, they told the true story. They both made clearly lower highs. Price is going up, but momentum is going down. That, my friends, is a classic bearish divergence. And the outcome here? Well, that signal was followed by a downturn that represented a potential maximum gain of 24.7% in just 9 weeks. It's just another powerful example of how this pattern can sometimes give you a little peek into a stock's potential future. Okay, so the setup clearly has some real potential. But, there are thousands of stocks out there. How do we sift through all of them to find the absolute best candidates? Well, the source gives us 5 specific tips to help kind of stack the odds in our favor. Here they are, the 5 filters to look for. First, the source is to favor stocks that already look expensive based on their price-to-sales ratio. Because, the higher they fly, the harder they can fall. Second, look for a high Zacks rank. Now, this sounds a little weird, I know, because the rank is on a 1 to 5 scale, where 1 is a strong buy, but 5 is a strong sell, so a high rank is actually bearish. Third, technically speaking, you want rallies that are super sharp, steeper than 45 degrees, because those tend to burn out faster. And finally, look for setups where that final price peak is stretched way, way far away from its 50-day moving average, kind of like a rubber band that's been pulled too tight. Put all those together, and you can really pinpoint the most vulnerable stocks. Okay, we've seen the theory, we've seen the examples, but what about the bigger picture? How did this strategy actually perform over a longer stretch of time? The source material gives us data from a 5-year backtest that gives us a pretty good idea of its historical performance. But before we look at a single number, we have to get this out of the way. It's a disclaimer from the source, and it's so important. Historical backtests, while they're super insightful, are never, ever a guarantee of future results. You know this. The market is always changing. So here's the data from the backtest, which ran from 2013 to 2018. It started with a hypothetical 10 grand, it made 69 trades, and it ended up with a profit of over $100,000. But here's the real kicker. This is a bearish strategy, and it was tested during a period that was, for the most part, a raging bull market. And that fact alone makes these results pretty remarkable. And this final comparison really just puts it all into perspective. Over that same 5-year bull market, the S&P 500 benchmark returned a very, very good 90%. I mean, that's great. However, the backtest for this bearish divergence strategy showed a total return of 432.1%. To be able to outperform the market by that much, especially with a bearish strategy in a bull market, well, that really shows its potential power.
So we'll just end with this thought. The big idea today is that the price you see on a chart doesn't always tell you the full story. By looking a little deeper, we found this hidden fight between price and momentum, and it just makes you wonder, if this one little disagreement can be so revealing, what other hidden stories are the charts just waiting to tell you?
All right, let's talk bear markets. They can be absolutely brutal, right? Especially if you're a trader who's used to buying breakouts. A falling market can feel like you're just stuck in the desert. But what if there was a specific, systematic plan just for the downside? Well, today, we're going to break down a strategy designed for exactly that. It's called the Blue Sea Breakdown. So here's the game plan. First, we'll talk about why bear markets are so tough. Then, we'll dive right into what the Blue Sea Breakdown actually is. After that, we'll get into the nitty-gritty, the 5 non-negotiable entry rules. We'll look at some real charts to see it in action. I'll share a few tips to increase your odds, and then, the moment of truth. We'll check out the performance data.
Okay, Section 1, Thriving in a Bear Market, a Trend Trader's Dilemma. Let's really set the stage here. When a bear market hits, your usual playbook, buying strength, chasing breakouts, it just stops working. And if you're a systematic trader, that's a huge problem.
So, what do you do when the market is falling? I mean, that's the million-dollar question, isn't it? Do you just sit on your hands and wait for the whole thing to blow over? Maybe try to catch some of those falling knives? Or is there another way? A way to actually participate in the market's direction, even when it's heading down?
And this quote, some trend traders are forced by a strong bear market to sit on the sidelines day after day. Wow, that really gets to the heart of the frustration, doesn't it? In these long, drawn-out bear markets, with no real rallies to speak of, it can feel like you're totally shut out of the game. You're just waiting and waiting for a setup that never seems to arrive. But the source material for this explainer says there's a key weapon you can use in these exact conditions.
And that weapon is the Blue Sea Breakdown. This is the counterintuitive solution. It's a setup that's designed specifically for these strongly trending bear markets. It gives you a systematic, rules-based way to approach the short side.
So what exactly is a Blue Sea Breakdown? Well, here's the definition. It's a bearish setup that aims to sell short low and cover lower by finding stocks that are breaking below key near-term support levels. The core idea is to find stocks already in a downtrend that are just now cracking a key support level. And that name, Blue Sea, it's a great visual. It refers to that open water, that new low territory where there's no recent price support to stop the fall. And the goal? Dead simple. Sell short low and cover even lower.
Now, you might already be familiar with the Blue Sky Breakout. That's the bullish version, where you buy stocks hitting brand new highs. If you get that, then this is super easy to understand. The Blue Sea Breakdown is basically its evil twin. It's the perfect mirror image, just pointed to the downside. One looks for a breakout to the upside, the other, a breakdown to the downside.
Okay, but let's be real for a second. Shorting a stock that's already hitting new lows, it can feel kind of weird, right? It goes against everything we're taught, that whole buy low, sell high instinct. So to get over that mental hurdle, try this little trick. Literally turn your chart upside down. Just flip it over. All of a sudden, that ugly, scary breakdown looks like a beautiful, tempting breakout. And if that inverted chart makes you want to smash the buy button, well, you flip it back over, and you know you've got a potentially powerful short setup right in front of you. All right, let's get into the nuts and bolts. This is the 5 entry rules, the non-negotiable blueprint. And that's the key word here, non-negotiable. This isn't about gut feelings. It's a systematic strategy. And for a setup to even be considered valid, it has to check all 5 of these boxes. No exceptions.
So here they are, the 5 rules of the Blue Sea Breakdown. We've got price, something called the min price multiple, on-balance volume or OBV, the MACD, and finally, the candle itself. These are the 5 pillars of the setup. Let's break down exactly what we're looking for in each one.
Okay, rule number 1, price. It's simple. The stock has to make a new closing low over the past 40 days. But, and this is super important, it cannot be a new 52-week low. Why? Because we're not looking for a stock that's been in free fall for an entire year. We want a near-term breakdown, a fresh crack in the price structure.
Rule number 2 is all about risk management. The price has to be more than 80% of its 52-week high. Think of this as a safety filter. Its whole purpose is to stop us from shorting stocks that have already completely crashed and burned. We don't want the washed-out names. So, for example, if a stock's 52-week high was $100, our entry price has to be above $80. This keeps us focused on stocks that, still have plenty of room to fall.
All right, now we need confirmation. A price breakdown by itself just isn't enough. So rule number 3, the on-balance volume, or OBV, must also be at its lowest reading over the past 40 days. The OBV is basically a running total of volume, and a new low tells you that the smart money is selling, that the volume is heavier on the down days. This confirms that sellers are firmly in control and that this breakdown has some real muscle behind it.
And we're not done with confirmation yet. Rule number 4 brings in momentum. The MACD line, and listen, this is important. We're talking about the MACD line, not the signal line or the histogram. It also has to be at its lowest reading over the past 40 days. What does this tell us? It tells us that downside momentum is picking up speed. It's the strongest it's been in about 2 months, and that is exactly the kind of win we wanted our backs for a short trade.
And finally, rule number 5. This is our last little sanity check. The candle on the breakdown day absolutely must be red or black, meaning the close is lower than the open. This is such a simple but powerful filter. It weeds out all those fake-outs where a stock might gap down hard on some bad news, but then buyers step in and it rallies all day long. No, we don't want that. We want stocks that closed weak, showing us that sellers were in charge right up to the closing bell.
Okay, theory's great, but what does this actually look like in the wild? Let's move on to breakdowns in action from theory to practice. We're going to walk through a couple of real-world examples right now.
Okay, check this out. This is a classic example in Autodesk, ticker ADSK. Look right there at point 2. You can see the price makes a new 40-day closing low, slicing right through that old support. And it meets our other price rules too. It's not a 52-week low, and it's still trading well above 80% of its high from point 1. Now, let's look at our confirmations.
Down below, at point 3, the MACD makes a new 40-day low. Boom. And at point 4, the OBV does the exact same thing. Double boom. It was a red candle that day, so tick, 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 tick. All 5 rules are met. That's a textbook valid short signal. Let's look at another one. This is Texas Capital, or TCBI. And on this chart, you can actually see 2 valid signals. The first one is there at point 2. Price breaks down, and you can see below that both the MACD and the OBV confirm with new lows. That's a go. Then, a little while later at point 5, we get another one. Price, momentum, and volume, they all line up perfectly again for a second valid short entry.
But hang on a second. What about that third potential signal, the one marked with the number 8? I mean, at first glance, it looks okay, right? The price is making another new 40-day low. So what makes this one an invalid trade? Why would we skip this one? Take a really close look at the indicators down below.
And here's the answer. This is exactly why every single one of those 5 rules is non-negotiable. Even though the price at point 8 is making a new low, look down at the MACD at point 9. See that? It's actually higher than its last low back at point 6. That's what we call a momentum divergence. Momentum is weakening. It's failing to confirm the new price low. So the setup fails the test. It's invalid. You skip the trade. And it's that kind of discipline that keeps you out of trouble.
Okay, so you've got the 5 core rules down pat. But what happens on a day when you get, say, 3 or 4 valid signals in different stocks? How do you pick the best of the best? Well, this next section is all about that. How to increase your odds, refining the edge. The source material gives us a few extra things to look for.
So, here are 4 pro tips for stacking the odds in your favor. First, try to favor stocks with really high price-to-sales ratios. These are often the most fundamentally overvalued and have the furthest to fall. Second, look for stocks that analysts already hate. You know, a bad Zacks rank, like a 4 or a 5, which is a sell or a strong sell. Third, these setups tend to work better when they break down from a nice, slow, rounded top pattern, not so much after a sharp V-shaped drop. And finally, if a breakdown happens because of some specific bad news, like a horrible earnings report or an analyst downgrade, that can often give it the extra fuel it needs to keep going.
Okay, this all sounds really good, doesn't it? The rules are clear, the logic makes sense, but the most important question for any trading strategy is always the same. But does it actually work? So let's get to the performance data and see what the numbers say. 1,019.2%. Let's just let that sink in for a second. Over a 5-year backtest, that was the total return. That's a pretty massive number, so let's unpack what's behind it. Okay, here's the full rundown. This backtest ran for 5 years, from 2013 to 2018, and it started with a hypothetical $10,000 account. Over that time, it triggered 321 trades. Now here's the kicker. Think about that time period. 2013 to 2018 was a massive, raging bull market. And yet, this bearish, short-only strategy still managed to find enough high-quality setups to not only survive, but to perform incredibly well.
And this bar chart really drives the point home. The annualized return for the Blue Sea Breakdown strategy during that time? 62.1%. Now to see just how crazy that is, let's compare it to just buying and holding the S&P 500. The market's annualized return over those same 5 years was 13.6%. So, yeah. And look, of course, we always have to say it. Past performance is never a guarantee of future results. But you gotta admit, that's some pretty compelling data for the strategy's historical edge.
So is it time to turn your charts upside down? At the end of the day, the Blue Sea Breakdown offers a clear, systematic, rules-based plan for tackling bear markets, a time when, let's face it, a lot of traders feel completely lost. It's all built on that simple logic of selling low to cover lower, but with very strict rules for price, risk, volume, and momentum. The biggest takeaway here isn't just this one strategy. It's the idea of having a plan for when things get ugly, which really does leave us with that one final thought. Maybe the next time you see a really ugly chart, the smartest thing you can do is just flip it on its head.
Welcome to The Explainer. Today, we're jumping into a trading setup that's, well, it's a little different. It's all about spotting weakness right where everyone else is seeing strength. It's called the Rising Wedge Breakdown, and it's a powerful contrarian strategy for experienced traders. This is a real game of patience and precision. And the source material for this one, it gets straight to the point. This quote right here is a serious warning. This is not a setup for guesswork. You have to be confident in what you're seeing because, as you'll find out, there's a good bit of subjective judgment involved here. So that begs the question, right? Why even bother with something so demanding? Well, the answer is pretty simple: the potential reward.
According to the research, this pattern can actually lead to some of the biggest returns out of all the bearish strategies. So yeah, it's definitely a valuable tool to have in your back pocket.
Okay, so here's how we're going to break it all down. First, we'll get into the core idea, the contrarian mindset. Then we'll build the setup piece by piece. After that, we'll run through the checklist you need to confirm it. Then, the fun part, we'll see it in action with some real charts. And finally, we'll look at the numbers and the rules to help stack the odds in your favor.
All right, let's kick things off with Section 1, the contrarian's edge. The whole philosophy here is about swimming against the current. It's about training your eyes to spot a weakness that's developing, even when the rest of the market is still feeling pretty bullish. That's where the real opportunity is hidden.
And this is the heart of the play. We are not looking to short a stock that's already weak and beaten down. Nope. We're looking for a stock that looks strong, that's in a clear uptrend, but it's starting to show these little subtle signs that it's running out of steam. And those signs suggest it's about to reverse course, and often very, very fast. So, how in the world do you spot that exhaustion? Well, it all starts with identifying a very specific pattern on the price chart. You can think of this as the foundation for the entire setup. So let's break down the anatomy of exactly what we're looking for.
And that pattern is called a rising wedge. The best way to picture it is to imagine the price bouncing between a floor of support and a ceiling of resistance. Now, in a rising wedge, both that floor and that ceiling are sloped up. But, and this is the key, the floor is rising faster than the ceiling. This action literally squeezes the price into a tighter and tighter coil. And, just like a compressed spring, all that tension often comes right before a really volatile release. And here it is. This is the perfect textbook version of the pattern. You can see it so clearly, the lower support line and the upper resistance line coming together, just squeezing the price. It's really important to get this ideal image in your head, because let's be honest, in the real world, these patterns are going to be a lot messier. This is the visual signature we're hunting for. But just seeing a wedge-like pattern isn't enough. We have two core conditions that are absolute non-negotiables. First, the stock has to be in an established uptrend. And for our purposes, we define that as the price being above a rising 50-day moving average. And second, for the wedge to be considered valid, the price has to touch both the support and the resistance trend lines at least 3 times. The more touches, the better, the more valid the pattern. Okay, so let's say we've found a stock that's in an uptrend, and it's forming a valid wedge. Our job still isn't done, not even close. Now we have to switch gears and become detectives. We need to start gathering more evidence from other technical indicators to really build a solid case that this pattern is likely to break to the downside. And this slide right here lays out our entire 5-step protocol. I want you to think of this as your pre-flight checklist. Every single one of these items has to be ticked off. We've already covered steps 1 and 2, confirming the uptrend and finding the wedge. So next up, we need to find something called bearish divergence on an indicator called the MACD. And then we have to wait for our final trigger signal from another indicator, the on-balance volume, or OBV. Only when all 4 of those conditions are met do we even think about step 5, executing the short sell. Now, it is absolutely crucial to understand the very different jobs these 2 indicators have. The MACD, that's our confirmation tool. Okay, imagine a car driving up a hill. The stock's price is the car, it's still moving up. But the MACD, that's like the engine's RPMs, and they're starting to fall. The car is still climbing, but the engine is losing power. That's exactly what bearish divergence is. It's telling us the momentum underneath is fading. The OBV, on the other hand, that's our trigger. It's all about volume, and when it breaks its own trend line, that is our final signal. That's the green light to go.
Theory is great, but let's see how this whole protocol actually comes together on a real chart. We're going to look at 2 really fascinating examples from the source material. So our first case study is Spark Therapeutics, ticker ONC. Let's walk right through the checklist. Okay, look at number 1. You see this beautiful, clean, rising wedge pattern, and the price is way above that rising 50-day moving average. So, check. Now look down at the MACD indicator at point number 2. See how the price in the wedge is making higher highs, but the MACD is making lower highs? That is your classic bearish divergence. Check. And then finally, at point number 3, we see the OVV indicator just slice right through its own support trend line. That's the trigger. An entry right there could have led to that dramatic fall you see at point 4, a potential 52% gain in just 8 weeks. Now this next chart for Yandex, this illustrates another really key point. So again, we see the setup. At number 1, we've got a long 3-month rising wedge. It's confirmed by the MACD divergence at number 2. But look really closely at number 3.
The OBV trend line breaks before the price actually breaks down out of the wedge pattern itself. Now that is a huge advantage. It gives you an early entry signal, which means you can potentially set a tighter stop loss and reduce your risk. And from that entry, the trade played out in two nice waves, down to points 4 and 5, for a potential 30% gain.
Now that we've seen it in action, let's kind of zoom out and look at the historical performance from the source's backtest, plus some important rules to help you filter for only the absolute best setups.
So, the big question, does this strategy actually work? Well, let's start with this number. In a 5-year manual backtest that the source performed on a curated watch list, this was the total return the strategy generated.
And here's the full breakdown from that test, which ran from 2013 to 2018. It took a starting equity of $10,000 and turned it into over $135,000. Now, the source is really clear to point out the caveats here. This was a manual test, not some automated mechanical thing, and the sample size of 81 trades is relatively small. But still, the numbers definitely suggest we're looking at a pretty robust system.
But what really puts the performance into perspective is this comparison. During that same 5-year period, and you got to remember that was a pretty strong bull market, the setup's annualized return was almost 68%. Compare that to just 13.6% for the S&P 500. I mean, that's not just beating the market, that is absolutely crushing it. So how can we filter for only the A-plus setups? The source gives us 3 key variables to look for. First, lean towards stocks with really stretched valuations, like a super high price-to-sales ratio. Second, favor the stocks that bearish analysts are already watching, like those with a Zacks rank of 5. And finally, and this is a big one, go for the longer, more drawn-out wedge patterns. The research shows that the longer a wedge takes to form, building that tension over months instead of just weeks, the more explosive the potential breakdown can be.
And we'll end with this final thought from the author. Because after all the technical analysis, after every single box on the protocol has been checked, there's also this element of intuition. The very best trades don't just look right on the chart, they have to feel right too. It's just a great reminder that trading is both a science and an art, and the most powerful setups are the ones where all that data and your gut feeling finally line up.
What if you could trade with a system that's, 100% mechanical? A system that takes all the emotion, all the guesswork right out of the equation. Well, that's exactly what we're going to break down today. A really powerful strategy right out of the book, Trend Trading for a Living, that runs on pure, unemotional rules.
And we're kicking things off with a pretty huge claim from the author himself. I mean, when someone who's been trading for decades says a system is their single most profitable strategy ever, you gotta sit up and pay attention. That sets a really high bar for what we're about to get into.
So that's really the big question for us, isn't it? How can a system with zero, and I mean zero, subjective guesswork, a system you could literally program a computer to follow, how can it consistently crank out such impressive results? We're going to answer that by taking this thing apart piece by piece.
Okay, so before we jump into the exact buy and sell rules, we need to get our heads around the basic idea that makes this whole thing work, and that concept is called mean reversion.
Here's the easiest way to think about it. Imagine a stock's price is attached to its average price, like its 20-day moving average, by a big rubber band. Now that price can stretch away from the average. It can shoot way up or drop way down, but it can only stretch so far. Eventually, that rubber band is going to want to snap back, right? It's going to pull the price back toward that average, or the mean. This entire system is designed to catch that exact moment of the snap.
So, how do we know when that rubber band is stretched to its absolute limit? Well, that's where Bollinger Bands come into play. These are the lines you see on a chart. Above and below the price, they get wider and narrower with volatility. They give us a clear, objective way to see when a price has gone too far, too fast, and is statistically likely to reverse course.
And this, right here, is the most crucial part of the whole thing. There is absolutely no room for interpretation. We are not squinting at chart patterns and asking, does that look like a reversal to you? No, the rules are all based on numbers. Did the price close above this specific line? Yes or no? Is this indicator at a certain level? Yes or no? It completely removes your emotions and my emotions and all the guesswork from the process. And that's what makes it so consistent.
So, with that core principle locked in, let's get to the actual blueprint. We're going to look at the 5 very specific, totally non-negotiable conditions that have to be met to trigger a valid trade, both on the buy side and the sell side. All right, for a bullish setup, a long trade, here are the 5 rules. You need all of them, no exceptions. First, yesterday's price had to close outside and below the lower Bollinger Band. That's our stretched rubber band signal. Second, yesterday had to be a down day, a red candle. Third, today the price has to snap back, closing back inside the bands. Fourth, and this one's critical, the price still needs to be at least 10% below its 20-day average. That means it has plenty of room to run back up. And finally, number 5, today's close has to be lower than yesterday's open. This just helps make sure we're not chasing a move that's already gone too far. When, and only when, all 5 of these conditions are true, you've got a valid buy signal.
And for a bearish or short setup, you guessed it, it's the perfect mirror image. Let's run through it quick. Yesterday, the price closed above the upper Bollinger Band on an up day. Second, a green candle. Third, today it's pulled back inside that band. Fourth, again, super important, it's still flying high, at least 10% above its 20-day average. And last, today's close is higher than yesterday's open. Again, just to make sure we're not late to the party. These 5 rules together give us a high probability signal to short the stock.
Now, this is where things get really, really interesting. Because finding a great entry is huge, but it's only half the battle, right? A perfect entry can be totally ruined by a bad exit. So how do you get out of these things?
This is the key question the author wanted to answer. It's not just about, did I make money? It's about, how much money did I make for every day I had my capital at risk? That's efficiency. And to find the answer, he put 4 different exit strategies to the test, head to head.
So check out this table. This shows the results of that showdown. You can see different methods being tested, like a classic stop loss or trying to take profits at a certain target. They were all profitable, which is great. It tells you the entry signal is solid. But I want you to look all the way over to that last column, percent PL per day, because that's the metric that tells us which strategy is the real moneymaker.
And here it is, the clear winner. This final strategy, which was just a simple timed exit, produced an average profit of 0.67% per day. Not only was it the most efficient, it also had the highest win rate at 71%. It just completely crushed the other more complex exit strategies. And this is the beautiful, almost mind-bending secret to the whole thing. The simplest, easiest strategy was also the most profitable. No messing with profit targets, no trailing stops. Just get in, and 7 trading days later, you get out, win or lose, period. It's a true set-it-and-forget-it approach that takes all the stress and decision-making out of the equation once you're in the trade.
Okay, so we've got the rules for getting in and the rule for getting out. But the million-dollar question remains, does this thing actually work? Let's look at the hard data, both from a real money account and a long-term backtest.
Now, this isn't some fantasy simulation. This is a documented, real money, 8-week test. A $10,000 portfolio trading only this system grew to over $12,800. That's a 28.5% gain in just 2 months. It averaged a net gain of 3.3% per trade pair. This is powerful stuff in a live-fire environment.
Okay, now let's zoom out. Big picture. This is a 5-year backtest from 2013 to 2018. If you had mechanically followed every single signal, a hypothetical $10,000 starting account would have grown to over $353,000. I mean, that's a total return of over 3,000%. The numbers are just staggering.
And to really put that into perspective, look at the annualized return. The system clocked in at an average of almost 103% per year. During that same time, just buying and holding the S&P 500 would have gotten you about 13.5%. So the system didn't just beat the market, it outperformed it by more than 7 times over.
Let's see this on a real chart to make it concrete. This is a stock called Jounce Therapeutics. See those circles? Those mark 7 valid bearish signals based on our rules. And look what happens after signals 1, 3, 5, 6, and 9. The price was stretched way up, and then boom, it snaps right back down towards its average. Even with a couple small losers, the total gain from these short trades was over 45%.
And here's the flip side, the bullish setup on USA Truck. Now, what's so fascinating here is that the stock itself was actually trending down over this period. But the system didn't care about the trend. It just spotted 5 long entry signals. And you can see how trades 1, 3, 4, and 5 just perfectly caught these powerful short-term snapback rallies. The stock lost value, but these trades pulled in a combined gain of over 49%. It just goes to show how this can work even in really choppy, messy markets.
So, last thing. While the system is 100% mechanical, the author does give a few extra filters you can apply. You don't have to, but think of them as ways to maybe boost your odds, especially if you get multiple signals on the same day and have to choose.
Think of these as tiebreakers. So for longs, you might lean towards stocks that are fundamentally a little cheaper or have good analyst ratings. For shorts, you do the opposite. You could also look for signals that pop up right near a major support or resistance level, or maybe near a big moving average like the 50-day or 200-day. It just adds another layer of confirmation to an already solid mechanical signal.
And that really brings us to the final and maybe the most important idea of all. We just broke down this incredibly profitable system, but the real lesson here might be even bigger. This whole thing works because it forces you to be disciplined. It takes your ego, your fear, your greed, and it throws them out the window. It leaves us with a really powerful question to think about. Is the true secret to trading success not about being some brilliant genius who can predict the future, but just having the simple discipline to follow a proven, mechanical plan day in and day out?
Let's talk about stock options. You know, for a lot of traders, they feel like the holy grail, the ultimate tool for incredible leverage and just massive, massive gains. But here's the thing, they are notoriously complex and, frankly, incredibly risky. So how do you actually harness their power without blowing up your account? Well, in this explainer, we're diving deep into the book Trend Trading for a Living to break down a system for doing just that, using options to maximize your gains and, just as important, minimize those scary risks.
And this is where things get really interesting. Take a look at this number on your screen, over 2,000%. That is the author's actual performance gain in his options advisory service over just 4 years. I mean, think about that. A starting account of, say, $10,000 would have ballooned to nearly $250,000. That right there is the incredible, seductive power of options. But, and this is a huge but, that number is not the whole story, not even close. Now, take a look at this. This is the equity curve from that same service. And yeah, sure, the overall trend is definitely up, but look how choppy and volatile that journey is. Those super sharp peaks and those terrifyingly deep valleys, well, that's the other side of the options coin. The exact same leverage that creates those staggering profits also makes options extraordinarily dangerous. This is not a smooth ride to the top. You absolutely have to know what you're doing, which is exactly what we're going to break down right now.
So to really get a handle on this, here's our game plan. We're going to start with the absolute basics of what options even are. Then we'll weigh the pros and cons, dive into a specific trader's rulebook, and then we'll explore 3 distinct strategies you can use. And we'll wrap up with maybe the most important question of all. Are options actually right for you? All right, let's start at the very beginning, square one. Because before we can even dream about strategies and big returns, we have to understand the fundamental building blocks. So what is a stock option, really? At its core, it's just a contract. And thankfully, there are really only 2 main types you need to know. First up, you have the call option. The easiest way to think about this is that it's a bullish bet. It's an optimistic bet. When you buy a call, you're buying the right, but not the obligation, to purchase 100 shares of a stock at a pre-agreed price. We call that the strike price. And you can do this anytime before the contract expires. So if the stock price soars way past your strike price, your right to buy it at that much lower price becomes super valuable. And on the flip side of a call, you have a put option. This is typically your bearish bet. Buying a put gives you the right to sell 100 shares of a stock at a set strike price. So if that stock's price just completely plummets, your right to sell it at that higher pre-agreed price is where you make your money.
And this right here, this is probably one of the most crucial concepts to get from the very start. Every single options contract has 2 sides. The person who buys the option has rights. They have the choice, the power to exercise their contract or just let it expire. But the person who sells the option, we call them the writer, they have obligations. They are obligated to make good on the deal if the buyer decides to exercise their right. One person has the choice, the other person has the duty.
Okay, so with those basics under our belt, let's get into the real heart of it all. Why are traders so drawn to options? And what are the massive dangers they need to be constantly aware of? Let's explore both the incredible leverage and the critical risks you're taking on. According to the source material, options are like a Swiss Army knife for traders. They're incredibly versatile. You can use them to hedge your stock portfolio, kind of like an insurance policy. You can use them to profit from volatility itself, and they make it way easier to bet against a stock than traditional shorting. But the single biggest advantage, the one that gets everyone excited, is leverage, pure, unadulterated leverage. And this table just illustrates that power perfectly. Let's say you think Facebook is going to go up from $180 to $200. You could go buy 100 shares. That would tie up $18,000 of your capital. If you're right, you make $2,000, which is a very respectable 11% return. Not bad. But now, look at the option trade. Instead, you could buy one call option contract for just $550. When the stock hits 200, that option could be worth $1,500, netting you a $950 profit. Now, yeah, the dollar amount is smaller, but your return on investment is a jaw-dropping 170%. You controlled the exact same number of shares for a tiny fraction of the cost. That is leverage.
Okay, but now we have to talk about the biggest disadvantage, the silent killer for option buyers. When you buy an option, you're buying a contract that has an expiration date. You're buying time, and time is constantly running out. We call this time value decay. The best analogy is that an option is like a melting ice cube. Every single day, it loses a little bit of its value, even if the stock price doesn't move an inch. And as you can see from this chart, that decay isn't a straight line. It accelerates like crazy, basically falling off a cliff in the last 30 days. It's a relentless force working against you.
And on top of that unavoidable time decay, there are other huge risks you have to know about. Unlike a stock, an option can, and very often does, expire completely worthless. That means you can lose 100% of your investment. Poof, gone. You also can't trade them before the market opens or after it closes. They're usually less liquid, which means wider price spreads, and some of the more advanced strategies are often flat out banned in retirement accounts like IRAs.
So, given these powerful pros and these really serious cons, how in the world do you actually navigate this market without getting burned? Well, the author lays out a very specific rulebook designed to manage these risks. So let's dig into this framework for trading. First up, for anyone buying options, the rules here are all about fighting that time decay and managing your risk. Rule 1, buy contracts with at least 3 to 4 months of life left. This keeps you way out of that steep part of the time decay curve we just saw. Rule 2, stick to strike prices that are at the money or slightly in the money. These have a much higher probability of success than those cheap, out-of-the-money lottery tickets. Rule 3, and this is absolutely crucial, use the 2% rule. Never, ever risk more than 2% of your entire account on any single trade. And finally, be way quicker to take your profits than you would with stocks, because that time decay can turn a winner into a loser in a hurry.
Now, what if you're on the other side of the trade, as an option seller? Well, you basically flip the whole script. Now you actually want to harness that time decay. So you sell contracts with 1 month or less to go, putting yourself right in that sweet spot where the decay is fastest. And you also want to sell options that are way out of the money, giving yourself this big, cushy safety buffer before the stock could ever reach your strike price. The trick is balancing that safety with getting paid enough premium for the risk you're taking.
And this next rule, well, it is probably the most counterintuitive one in the entire book. The author is adamant about this. Never use stop-loss orders on options. Now, why on earth would he say that? Because the price spreads on options can be really wide, and it's just too easy for market makers to briefly push the price, trigger your stop, and knock you out of a perfectly good trade. The better way to do it, he says, is to set a price alert on the stock itself. And then, if that alert gets hit, you go in and manually close your option position.
Okay, so with that rulebook as our foundation, let's look at how to put it all into practice. The book lays out 3 distinct strategic blueprints we can follow.
Strategy number 1 is the most straightforward. It's the direct bet. This is what most people think of when they hear options trading. You're bullish, you buy a call. You're bearish, you buy a put. It's simple, it requires the least amount of cash, and it offers the absolute highest potential reward because of that wild leverage. But what's the trade-off? It also has the lowest probability of success. You have to be right on the direction and the timing to beat that ticking clock of time decay. Now, strategy number 2 is for the more conservative folks out there, the income generator. This is where you combine owning stock with selling options. A classic example is the covered call. You buy 100 shares of a stock you like, and then you sell a call option against those shares. This brings in immediate cash from the premium you collect, but it also puts a cap on your potential profits. So it's a really high probability strategy, but you're trading away those huge home run gains for more consistent, smaller wins. And that brings us to strategy number 3, which is the author's personal favorite, the high probability play. This involves selling naked puts on stocks that you're bullish on. Think about it like this. You're essentially getting paid today for agreeing to buy a stock you already like, but at a lower price than it's currently trading. This approach has a very, very high win rate because you make money if the stock goes up, stays flat, or even goes down a little bit. The catch? You need a margin account and enough cash on hand in case the stock does fall and you're forced to actually buy the shares. So let's just pull this all together. This table gives us a fantastic summary. Strategy 1, buying calls and puts, is all about max leverage. It's low on cash needed, but it has a low win rate. Strategy 2, covered calls, is for income generation. You need a lot of cash to own the stock, but your win rate is high. And strategy 3, selling naked puts, is for high probability income. It needs a medium amount of capital in a margin account, but it offers a very high win rate. You can see how each one has a totally distinct risk and reward profile. We have covered a ton of ground. The what, the why, and the how. But that leaves us with the single most important question that you have to answer for yourself before you ever place a single options trade. And here it is. This is the single most important piece of advice in the entire book. I'm just going to read it directly. You can be a successful stock options trader only if you are already a successful stock trader. Let that sink in. The critical point is this: options are not a shortcut. They are not a way for beginners to make up for a lack of skill. They are an advanced tool that adds even more layers of complexity, like time decay and volatility, on top of the already difficult job of just predicting a stock's direction. So we'll end with this thought. Options absolutely offer incredible, game-changing leverage. There's no doubt about it. But the real question isn't about the potential reward. It's about your preparation. Have you already mastered the fundamentals of trading stocks first? And are you truly prepared to understand and actively manage the unique, complex, and relentless risks that come with every single options trade you make?
So, what's the real difference between a professional trader and everyone else? I'll tell you right now. It's not about having some kind of crystal ball or a secret stock tip. It's about something way more important: a disciplined, rock-solid playbook for managing their money. Today, we're going to tear down their rules for how to get in, how to get out, and exactly how much to bet on every single trade. Let's do this.
Okay, I know what you're thinking. That sounds completely backward, doesn't it? We spend all our time, all our energy trying to find that one perfect moment to buy. But the pros? For them, the entry is just the price of admission. They're already playing chess 3 moves ahead. And seriously, getting your head around this one single idea will completely change the way you see the market.
And this is where you see the huge gap. You know, amateurs are always asking, when do I get in? Is now the right time to buy? The professional is obsessed with a totally different set of questions. Where is my emergency exit if this trade goes wrong? And what's my plan to take profits if it goes right? They know deep down that the end game is where the real money is made or lost.
This really gets to the heart of it. The amateur trader is basically just floating in a sea of emotions, right? There's hope, there's fear, there's greed. But the professional, they operate from a rule book. They've built a system for one reason and one reason only: to take their emotions completely out of the equation, because emotion is the single biggest threat to their capital.
All right, let's get tactical. We're going to start with what is, believe it or not, the easiest part of the whole process: actually entering the trade. So you've done your homework, you've found a great setup. How do you pull the trigger? Well, the pros keep it super simple. They really only use 2 main protocols.
So your choice here really just comes down to your lifestyle, your schedule. If you can be at your desk near the end of the trading day, a market on close order, or MOC, is great. It guarantees you get in at the closing price. No fuss. But if you've got a day job, your go-to is going to be a stop limit order that you set the night before. This thing only triggers if the stock actually starts moving your way, which is a nice little filter. The only downside is you might miss some of those huge overnight gap ups.
Now we get to it. This is, without a doubt, the single most critical skill for survival in the markets. It's all about playing defense. I know it's not exciting, it's not glamorous, but mastering this is the absolute foundation of a long-term trading career. And it all boils down to one thing: knowing exactly where you're getting out before you even get in.
And let's be crystal clear about what a stop loss is. It is not some vague idea. It's not a mental stop or an area you're watching. It is an exact price.
It is a hard line in the sand. If the stock touches that price, you are out. No questions asked. No hoping it'll bounce back. You just exit. This is your shield. This is what protects your capital so you can live to trade another day.
And the thing is, you've got a whole toolkit for this. The pros don't just use one type of stop for every trade. They have different methods that are suited for different stocks and different market conditions. You can think of them like different defensive plays you can call depending on what the market's throwing at you.
But look, if you just need one simple, brutally effective rule to get you started, here it is. As a trend trader, you should almost never, ever let a single trade lose more than 8%. Period. And this isn't some random number. Think about it. A 10% loss needs an 11% gain to get back to even. A 25% loss needs a 33% gain. A 50% loss, you need to double your money, 100% gain, just to break even. This hard 8% rule prevents that kind of catastrophic damage to your account.
Now, for a more sophisticated approach, you can actually let the stock's own personality set the stop for you. You can use its average true range, the ATR, which is really just a fancy way of measuring its normal daily wiggle. Or you can use obvious price levels, like support. This creates a more dynamic stop that's tailored to the specific character of that stock.
And here's a perfect example of how this works in the real world. See those little dots? That's a type of trailing stop called the parabolic SAR. Look at that beautiful trend in the middle. The dots trail the price perfectly, keeping you in the trade and locking in profit. But look what happens in those choppy, sideways areas on the left and right. You get whipsawed in and out, taking one small loss after another. It's an incredible tool for sure, but only when the conditions are right.
Okay, defense is covered. Now let's flip the script and talk offense. The fun part, right? Taking profits. But honestly, this can be just as difficult as cutting a loss because the exact same enemies are at play. Greed tells you to hold on for just a little bit more, while fear screams at you to sell way too early and leave a ton of money on the table.
And just like with your defense, you've got a playbook for your offense. You can set a fixed target, maybe aim for 2 times whatever you risked. You could sell at a clear resistance level on the chart. You could use that ATR thing again to project a target, or you could use what the pros know is by far the most powerful method over the long run.
This is probably one of the oldest and wisest sayings in all of trading. You know, so many people think the goal is to have a high win rate, to be right 70 or 80% of the time. But that's not it at all. The real goal is to make your winning trades massively, exponentially larger than your losing trades. And the only way to do that is to let your winners run.
So here's the bottom line. Setting fixed profit targets, yeah, that'll get you a steady stream of singles and doubles. And that's okay. But it also means you will never, ever hit a grand slam. A trailing stop is the only method that keeps you strapped in for those massive, account-changing trends, the kind of moves that can literally make your entire year. Legendary traders aren't built on a bunch of small wins. They're built on riding a few enormous trends all the way to the end.
Okay, so we've covered how to manage a single trade from start to finish. But what about the big picture? How do you manage your whole portfolio? How much of your hard-earned cash do you actually put into each idea? This is called position sizing, and frankly, it's where most amateurs completely blow themselves up. So where do you begin? The recommendation is a number that's going to sound way too simple. 3. That's it. Just 3 open trades at any one time. Now I know, that might not sound like enough, but the power of focusing all of your capital, and more importantly, all of your mental energy on just a few of your absolute best ideas, well, it's incredible. And if you think that sounds too simple to work, well, here's the proof. This is a real-world model, trading just 3 stocks at a time. A starting account of $3,000 grew to over $2.1 million in 8 years. Just take a second and let that number sink in. That is the unbelievable power of focus and compounding.
And this wasn't some kind of fluke. Here's another example using a totally different strategy, but with the same rule. Trade just 3 positions. In this case, $3,000 grew to over $2.9 million. The principle is exactly the same. Concentrate your bets and let your winners do the heavy lifting for you.
And here's the actual protocol, step by step. It's simple. You start with 3 trades, splitting your capital evenly. Then, for every $1,000 your account grows, you can add 1 more position. Once you hit $10,000 in your account, you stop at 10 positions. From that point on, you don't add more stocks. Instead, you start increasing the amount of money you put into each of those 10 trades. This way, you systematically scale your risk as your account grows.
So there you have it.
We've just walked through the entire professional playbook: how to get in, how to get out, and how to size your bets. You have the knowledge now. But, and this is a huge but, the single most important ingredient for success, well, you're not going to find it in this explainer or in any book for that matter.
There is absolutely no substitute for screen time, for real money experience, for feeling the pit in your stomach when a trade goes against you. All of these rules we just talked about, they're completely worthless without the hundreds and thousands of hours it takes to apply them, to make mistakes, to learn, and to slowly build the emotional control you need to execute your plan when it counts. And that brings us to the final and toughest challenge. There's this massive canyon between knowing what to do and actually doing it. And the bridge that gets you across that canyon is one thing: discipline. It's the ability to follow your rules day in and day out, with your own money on the line. Building that bridge is the last and most important step on the path to becoming a pro. So you have the complete playbook now. You know how to enter, you know where to set your stop loss, you know how to take profits, and you know how to size your positions. The only question left is the one that really, truly matters. You have the professional's playbook. Do you have the discipline to actually use it?
Hey everyone, welcome. So today we're going to talk about where trend trading can really take you. And I'll give you a little hint. It's a destination that's way beyond just a bigger bank account. We're going to unpack how the whole discipline of trading can shape not just your portfolio, but your character.
So this simple phrase right here is the motto that really kicks off our entire journey. It's inspired by Alexander Elder's famous book, and it just perfectly captures this powerful dual idea. Trade for a living? Yeah, that speaks to that hope we all have for a better life, for financial freedom. But trade for life? Well, that's getting at something much, much deeper. It's about how the very act of trading can help you build a richer, more meaningful life, in every sense of the word.
All right, so this is the core idea we're going to get into today. The market, you see, it offers this dual promise. On one hand, of course, it's a vehicle that can, if you have the right mindset and the right tools, help you achieve financial success. Paying off debt, funding college, maybe even retiring early. But on the other hand, it's also a school. It's a teacher of character.
Let's be real for a second. Traders sometimes get a bad rap. The stereotype is often that loud, self-centered, mad money clown you see in the movies, right? But for every one of those, there are probably 10 serious, principled traders who are quietly building a solid living. But here's the real kicker. The argument is that they are this way because of their trading, not in spite of it. It seems the market itself has a funny way of reinforcing virtuous habits.
So, if trading really is a school of character, you gotta ask, right? What's on the curriculum? Well, the author lays out 5 specific lessons, or you could call them virtues, that are forged in the fires of the market. And these aren't just good habits for trading, you guys, they're good habits for living. Thinking about it this way, it completely changes your perspective on what you're even doing when you place a trade.
So here they are, the 5 core virtues that get hammered out by the market: patience, listening, forgiveness, holding your biases loosely, and of course, humility. Let's walk through each one and really see how the daily grind of trading can teach us such profound life lessons.
First up, patience. And boy, is this a big one. Impatient traders, they never win, period. They act on impulse, they panic, they dump small losers right before they turn into huge winners. The trading game is a marathon, not a sprint. You have to settle into this quiet, efficient pace if you want to last. If you go out too fast, too impulsively, you're just going to burn out long before you even see the finish line. Real success in trading demands the strength to simply wait.
The second lesson is all about listening. And I'm not talking about that constant chatter inside your own head. I'm talking about listening to the market itself. To be a great trader, you have to become a great listener. The chart is described here as a form of language. The price patterns, the indicators, the volume, these are the words the market uses to speak to us. And our job is to just listen carefully enough to figure out if it's speaking beautiful music or if it's just making a bunch of noise.
Okay, now this is a big one. Forgiveness. Imagine this. You find the perfect trade setup. Everything looks amazing. It starts out great. It's up 7% in just 3 days. Then, bam. Overnight, some unexpected bad news hits. The stock gaps down, meaning it opens way lower than it closed. And it just blows right past your stop loss, your safety net, and leaves you with a loss. The natural reaction? It's the blame game. Blaming the company, or the shame game, blaming yourself. Trading forces you to get past that. It teaches you to forgive the company, to forgive the chart, and most importantly, to forgive yourself and then move on.
It is an absolutely essential lesson for life.
And, this leads us right into our fourth lesson, holding your biases loosely. Look, we all need some kind of initial bias, bullish or bearish, just to get interested in a trade. But the real danger is in clinging to that bias too tightly. The successful trader lives by this simple mantra: let the markets market. Let the market tell you where it's going. If your first read was wrong, you have to be willing to let it go and just follow the market's lead.
And that brings us to the final, and maybe the most vital lesson of them all: humility. The author makes such a powerful point with this, provocative reimagining of the Sermon on the Mount. The message is that only the humble can actually see what's real. And let me tell you, trading is a profoundly humbling experience. The markets are just way too big for any single person to conquer.
Yeah, this sums it up perfectly, doesn't it? The prideful trader, they try to be the master of the markets, to outthink everybody. But that attitude is just a fast track to ruin. The successful, humble trader, they take a submissive posture. They follow time-tested systems and let the market lead the way. They know that their systems and the market itself know better than they do. Humility isn't weakness. In trading, it's where all the strength comes from.
Okay, so we've been looking inward, right, at all those character lessons. Now, let's switch gears and look outward. We're going to share a really big vision for where this whole trend trading phenomenon could go, and it's all about making the benefits of trading accessible to way more people.
This whole vision really rests on three main pillars. First, creating these communal trading centers. Second, developing what are called automated money machines. And third, building a widespread personal trading coaches network. So let's break down what each of these actually means.
Okay, first up, trading centers. Now, I want you to forget the image of some old, sketchy prop shop. The vision here is for something completely different. Imagine these cool, inviting storefronts in your local mall. Places with trading stations, financial news on big flat screens, seminars happening in the back room, and great espresso during market hours. The idea is Goldman Sachs meets Starbucks, a communal, educational, and social hub for traders. How cool would that be?
Now for the second idea, and this one's a little more futuristic. What if you could keep your day job but still trade effectively? This question gets right to the heart of this automated money machine concept. Software that could screen for setups, suggest your entries and stops, and even send the orders to your broker automatically.
But wait a second. This amazing idea immediately hits a huge roadblock, right? A massive logistical problem. What happens when the system gets really popular? I mean, if 20,000 people all get a signal to buy the exact same stock at the exact same price, you've got chaos. The order flow would be just overwhelming. The stock would either gap up, leaving everyone in the dust, or it would just collapse under all that volume. So does that kill the whole idea?
No, not at all. Because there's a really clever solution: diversification. You don't build one money machine, you build dozens of them. You create different automated systems for day traders, for swing traders, for position traders. You build machines for different risk tolerances, different sectors, for ETFs, for Forex, you name it. By diversifying the signals across dozens of unique systems, you spread out the order flow, you reduce the risk, and the whole concept becomes viable again. Pretty smart.
And now we've arrived at the final and honestly the most profound part of this whole journey. After exploring all the virtues and the future vision, the author tackles the dangers of trading head-on. The stress, the emotional roller coaster, the potential for addiction. And then he presents this incredibly powerful way to transform the entire practice and give it true, lasting meaning.
See, the problem with trading, if we're being honest, is that its only goal is to make money. And money, well, it can have a corrosive influence on our lives. So what's the solution? A radical shift in your primary objective. The goal has to be transformed from simply making money to being generous.
This right here, this is the absolute key. The author puts it perfectly. Do not set making money as the goal. Instead, set being more generous as the goal. Just let that sink in for a second. This single change in perspective reframes everything. Trading is no longer just a self-serving act. When generosity is the goal, making money becomes the means to a much more noble and meaningful end. It completely transforms the entire activity.
And just like that, trading suddenly has a purpose that goes way beyond your own account balance. It becomes a tool, a catalyst for helping others. The author shares his own personal examples, how money from his trading has helped pay off a church mortgage, rescue children from trafficking, and feed orphans. When you frame it this way, the skills of a trader can be used to add immense value to the world.
And that leaves us with this final, powerful question.
If we accept that trading is just a tool, a very powerful one, but still just a tool, then the most important question isn't about which stock to buy tomorrow. It's about what you intend to build with it. Is it going to be a monument to yourself, or will you choose to build something that benefits others and adds real, tangible value to the world? The choice, ultimately, is yours. Thanks for joining me to think about that.